company and draws a salary of $10,000 per month. He recently opened a personal account at the National Bank near his home for operational convenience. He started depositing a part of his salary in the newly opened personal account. The bank pays him interest at 5% per annum for the deposits made. Few months back, he started a recurring deposit and contributes $500 every month, which can be withdrawn after 1 year along with the interest at 10%. He also deposited $25,000 in a fixed deposit scheme for which the bank will pay him a cumulative interest of 8% per annum. Mark recently borrowed $1 million as a housing loan from the National Bank, for which the bank charges him 18% interest. Mark agrees to transfer the amount every month through net banking. If you look at the activities of Mark, it is evident that he has almost utilized all the basic services which a bank provides to its customers. All these banks pay interest to its customers for the deposits made, which is an expenditure to the bank, and on the other hand, by charging higher interest for the loans, the banks earn profit. Let us now learn basics of banking in detail. These are the objectives we will be covering during this course. Introduction to banking, banking regulation, bank customer relationship, types of customers and their accounts, deposit accounts, negotiable instruments and related matters, loans and advances, fee-based banking services, electronic banking, marketing of bank products, know your customer, KYC. So let's begin basics of banking. Our first objective to cover in this course is Introduction to Banking. What is the meaning of bank or banking? The word bank means an organization where people and business can invest or borrow money, change it to foreign currency, etc. Gerald Klein of University of London explains, bank as a body, corporate or not, that has been recognized by the Bank of England under the Banking Act 1987 to accept deposits as defined by that act. In UK, there is no statutory definition of a bank or a banker. Who cannot be a banker? A person or corporate body cannot be a banker if they do not take deposit accounts, take current accounts, issue and pay checks, collect checks for customers. Here are the basic principles of banking. Number 1, principle of intermediation. Number 2, principle of liquidity. Number 3, principle of profitability. Number 4, principle of solvency. Number 5, principle of trust. Let's take a look at each of these principles in detail. Number 1 is principle of intermediation. Banks are called financial intermediaries because they invest or lend funds of depositors who themselves are unable to lend their funds due to risk and other factors involved in direct lending. Banks assume the credit risk involved in direct lending to those who need funds. They have the expertise and abilities to manage such risks. Number 2 is principle of liquidity. As per this principle, a bank must keep a certain portion of its deposit liabilities in liquid form so as to be able to repay the same on demand or maturity dates to the depositors. The acceptance of deposits and lending these funds to borrowers in a manner such that the bank would be able to arrange for the funds demanded by its depositors at any point of time. It is called liquidity management or asset liability management. Number 3, principle of profitability. Interest income, which represents the interest differential between its loans and deposits rates, is the main source of profit for a bank. Interest income, along with the non-interest or fee-based income, contributes to the bulk of a bank's profits. Principle of solvency. Solvency connotes long-term financial soundness of a bank, achieved by adherence to prudent policies in lending, retention of some part of profits for business growth, implementation of professional management systems, and following the mandatory rules and procedures in day-to-day operations. Number 5, principle of trust. The trust that customers, existing and potential, repose in a bank is its hallmark, as it connotes dependability in the opinion of its customers. Trustworthiness is a function of a bank's good track record over a fairly long period of time in terms of liquidity, profitability, financial soundness, and its record of meeting its commitments to all concerned parties. Functions of banks. Functions of a bank can be classified as traditional, or co-functions. These are performed by almost every bank, irrespective of its size, ownership pattern, and operational area. Modern functions. These are mostly performed by large-sized or modern banks situated in commercial centers or metros. Traditional functions of banks are accepting deposits, lending, funds remittance, miscellaneous services. Let's take a look at each of these in detail. Accepting deposits. A bank accepts money from its customers and keeps the funds in non-interest bearing accounts or interest bearing accounts as per the choice of the customer while opening the account. Deposits constitute the largest portion of a bank's funds apart from its own capital. Deposits are repayable on demand or on specific maturity dates. Lending. Funds mobilized through deposits are deployed by a bank in making loans and advances to earn profits by way of interest spreads. Lending requires adequate care, caution, and supervision by the bank's management at various levels. Funds remittance. Banks remit customers' funds from one place to another in the same country or overseas through their branches and correspondent banks by mail or electronic funds transfer or by issuing bank drafts for which a small commission is charged from the remitting person. Miscellaneous services. These miscellaneous services include issue of credit or debit cards, safe deposit lockers, safe custody of valuables, issuance of travelers' checks, letter of credit and guarantees, collection of outstation checks and bills, furnishing opinion reports on their customers, acting as agency services for government business, correspondence, trusteeship and executors business. Modern banking functions. Modern banking is about providing an array of services to customers under one roof so as to enable banking with convenience. The modern commercial banking function mainly comprises of activities such as cross-border banking, merchant banking, credit cards, factoring, leasing, and insurance and other financial services undertaken by the banks. Cross-border fundraising services. Cross-border banking is classified as follows: external commercial borrowing (ECB), global depository receipts or international depository receipts, non-resident external or foreign currency non-resident accounts, syndication of foreign currency loans. Cross-border banking services include import, financing or leasing, export, functioning or forfeiting or leasing. Let's take a look at merchant banking. Merchant banking refers to dealing with the securities on fee basis without outlay of funds to the clients. Merchant banking involves disintermediation as it helps savers to invest directly in the shares of companies instead of depositing their savings with banks. Merchant banking provides lucrative fee-based business for modern banks but is done mainly by specialized subsidiaries of banks. Here are some of the emerging trends in the banking sector. They are universal banking, electronic banking, globalization of banking. Here's a question for you. Which one of the following is a cross-border activity of a bank? Is it miscellaneous services, modern banking, traditional banking, external commercial? Let's move on to our next objective in the course, banking regulation. In the UK, where banking has not been defined under any statute book, the banking system is regulated by the Bank of England in terms of an enactment. Similarly, the Federal Reserve Board regulates the banking system in the Federation of States of USA. The rationale of regulation of financial or banking system is to generate, maintain, promote confidence and trust of the public in the financial banking system, to protect investors' interests through adequate or timely disclosure by the institutions and access to revenue information by the investors, to ensure that the financial markets are both fair and efficient, to ensure that the participants measure up to the rules of the marketplace. Following are the essential functions of the central bank of a country: issuing notes, government's banker, banker's bank, bank's supervision, development of financial system, exchange control, monetary policy. The following are considered as the tools of monetary control. Number 1, CRR, which is cash reserve ratio. Number 2, statutory liquidity ratio, SLR. Number 3, bank rate. Number 4, open market operations, also known as OMO. Number 5, selective credit control or SEC. Let's take a look at each of these tools in detail. Number 1 is cash reserve ratio or CRR. This refers to the cash that all banks are required to maintain with the central bank as a certain percentage of their demand and time liabilities. In order to meet the liabilities in time, a bank has to keep the regulatory cash reserve with the central bank. SLR or statutory liquidity ratio is maintained by all banks in the form of cash in hand. Increase in SLR results in the reduction of the lending capacity of banks by preempting certain portion of their demand and time liabilities or other approved securities. Bank rate. Bank rate is the standard rate at which the central bank is prepared to buy or rediscount bills of exchange or other eligible commercial papers from banks. It is the basic cost of rediscounting and refinance of facilities provided by the central bank. Open market operations or OMO. This refers to the sale or the purchase of government securities by the central bank in the open market with a view to increase or decrease the liquidity in the banking system and thereby affecting the loanable funds with banks. The central bank issues SCC directives with an objective to prevent speculative holding of essential commodities, which results in a rise in their prices. The other tools of monetary control are credit rationing or allocation, credit authorization scheme, credit planning, inventory and credit norms. Let's take a look at our next objective, bank-customer relationship. Who is a customer? A customer is a person who has some sort of account, either deposit or current account, or some similar relation with a bank, and from this it follows that any person may become a customer by opening a deposit or current account or having some similar relation with the bank. Here are the features of bank-customer relationship. A customer is one who maintains some kind of deposit account with a bank, irrespective of the duration for which the account has been maintained. A customer of a bank may be a natural person or legal entity, example, a firm, company, a corporation, an association, etc. The state of the account, whether in debit or in credit, is immaterial for this relationship. A customer of one branch of a bank does not become a customer of another branch of the same bank where he does not maintain any bank account. The different forms of relationship between a bank and a customer are: Number 1. Bank as debtor. The principal relationship of bank customer is that of debtor-creditor in case of deposit accounts like savings, current, fixed and recurring deposits. If the customer wants money, he or she has to make the demand to the bank to repay the money at a particular branch where the account is kept. Number 2, bank as creditor. The relationship between bank customer becomes that of creditor-debtor when customer has borrowed money from the bank by the way of overdraft, cash credit, demand loan, term loan, bills discount or any other kind of loan or advance. The bank can demand money from the customer with the agreed interest from the customer according to the terms and conditions. Bank as trustee. This relationship arises when a customer deposits securities or other valuables with the bank for safe custody. The customer continues to be the owner of the securities and the bank is supposed to only deal with them as per the customer's instructions. Number 4 is bank as agent. The agent-principal relationship of bank-customer arises quite often when a bank collects checks or bills of exchange or other instruments on behalf of its customers or buys or sells securities on its behalf. It is acting as an agent of its customer. The bank has to act with reasonable diligence and skill, failing which it may become liable to make good the loss caused by its negligence. Number 5 is bank as bailey. A bank acts as a bailey when it accepts a sealed box item for safe custody from a person. As a bailey, the bank is bound to take as much care of the goods bailed to it as a man of ordinary prudence would do under similar circumstances. The duties of a bank can be categorized in 2 categories: duty of secrecy, duty of reasonable care. Let's take a look at each of these in detail. Duty of secrecy. The debtor-creditor relationship between a bank customer is of a special kind. It is a contractual relationship that has an implied obligation to keep the affairs of the account of customers secret and confidential. The duty of non-disclosure is contractual and legal. Though not absolute, it is yet qualified. A bank would be protected only if it discloses the affairs of the customers under certain legally permissible compulsions. Duty of reasonable care. It is the bank's duty of exercising reasonable care or diligence while discharging its duty as agent or bailey or a trustee of a customer. If a customer suffers loss due to improper care or negligence of the bank, he or she may claim specific damages from the bank for making good the loss. Further, a bank may also be held liable for wrongful dishonor of checks when there is sufficient balance in the customer's account. Rights of a bank. There are certain rights conferred on the banks. They are bank's lien, right to set off, right of appropriation of accounts, right to charge interest or commission. Termination of bank-customer relationship. There are two modes of termination which are listed below: voluntary termination, termination by law. Let us take a look at each of these in detail. Voluntary termination. The customer has a right to close his deposit account because of change of residence or dissatisfaction with the service of the bank or for any other reason, and the bank is bound to comply with this request. The bank can also close an account due to unsatisfactory conduct of the account or because it finds the customer undesirable for certain reasons. Termination by law. The relationship of a bank customer can also be terminated by the process of law due to the following reasons: death of a customer, bankruptcy of a customer or liquidation of a company, garnishee order, insanity of the customer. Let us now look at a real-life example to understand the customer-bank relationship. In the next few slides, you will see various types of customer-bank relationship present in each transaction. You need to go through these transactions and find out the type of relationship that exists in the transaction. Benjamin has deposited gold jewels worth $2 million in the safety locker facility available with his bank. He has also paid the annual maintenance fees to the bank regularly. Can you analyze what type of relationship exists between the bank and the customer in this transaction? Bank as trustee is the type of relationship involved here. This relationship arises when a customer deposits securities or other valuables with the bank for safe custody. The customer continues to be the owner of the securities and the bank is supposed to only deal with them as per the customer's instructions. Alex is working as a designer in a leading studio and has been depositing regularly in the global bank. He has a total deposits of $50,000 and now he withdraws $20,000 using a self-withdrawal check. Can you find out what type of a relationship is present in this type of transaction? Bank as debtor is the type of relationship involved here. The principal relationship of bank customer is that of debtor-creditor in case of deposit accounts like savings, current, fixed, and recurring deposits. If the customer wants money, he or she has to make the demand to the bank to repay the money at a particular branch where the account is kept. The Central Bank, California branch has received a sealed cover from its head office for one of its customers. The sealed cover consists of various important documents which the customer has to fill in and submit it to the head office. What type of a relationship exists between the branch and the customer in this transaction? Bank as bailee is the type of a relationship involved here. A bank acts as bailee when it accepts a sealed box item for safe custody from a person. As a bailee, the bank is bound to take as much care of the goods bailed to it as a man of ordinary prudence would do under similar circumstances. John Maxwell maintains a personal account at Helios Bank. John recently bought stocks worth $12,000 and he has instructed the bank to transfer the funds to the stockbroker. What type of relationship is involved in this kind of a transaction? Bank as agent is the type of relationship involved here. The agent-principal relationship of bank customer arises quite often. When a bank collects checks or bills of exchange or other instruments on behalf of its customers or buys or sells securities on its behalf, it is acting as an agent of its customer. The bank has to act with reasonable diligence and skill, failing which it may become liable to make good the loss caused by its negligence. Russell works as an analyst in a stockbroking firm. He had borrowed funds from his bank to start a business. He has agreed to repay the loan every month on equal installments for 10 years. What type of relationship exists between the customer bank in this transaction? Bank as creditor is the type of relationship involved here. The relationship between bank customer becomes that of creditor-debtor when customer has borrowed money from the bank by way of overdraft, cash credit, demand loan, term loan, bills discount, or any other kind of loan or advance. The bank can demand money from the customer with the agreed interest from the customer according to the terms and conditions. Our next objective in the course is types of customers and their accounts. Opening of deposit accounts. Any person who is competent to contract can open a deposit account with a bank branch of his or her choice and convenience. For entering into a valid contract, a person needs to fulfill the basic requirements. The following are the different types of customers who can open an account with a bank: individuals, companies, trusts, clubs. Let's look at each of these in detail. Individuals. Accounts of individuals form a major chunk of the deposit accounts in the personal segment of most banks. Individuals who are eligible and with a sound mind can open a bank account. Companies. A company is a legal entity distinct from its shareholders or managers, as it can sue and be sued in its own name. It is a perpetual entity until dissolved. Its operations are governed by the provisions of the Companies Act existing in that country. Trusts. A trust is a relationship where a person holds property for the benefit of another person or some object in a way such that the real benefit of the property accrues to the beneficiary or the object of the trust. Clubs. Account of a proprietary club can be opened like an individual account. However, clubs that are collectively owned by several members and are not registered under any act are treated like an unregistered firm. Our next objective is deposit accounts. Let us now understand the importance of deposits for number 1, a bank, number 2, depositors, number 3, the economy. Let's take a look at each of these in detail. Number 1, for a bank. Deposit taking means accepting money or its equivalents for keeping in deposit accounts. It is the most important function of a commercial bank since it enables a bank to accumulate funds required for its other major function vis-a-vis lending to industry, trade and commerce. Number 2 is depositors. For depositors, depositors keep their savings and business funds with commercial banks due to a host of advantages they receive from the banks. The main advantages for the customers, the depositors, are liquidity or easy withdrawals, safety of funds, earning interest on savings or term deposits, record keeping, quick and convenient transferability of funds. Number 3, for economy. Commercial banks mobilize a large portion of the savings of the community and deploy the same in loans and advances to the industry, trade, agriculture, infrastructure, services sector and other bankable economic activities, thereby helping the economy to develop. This function of the bank is called financial intermediation. Banks thus play an important role in the economic growth of the country by channelizing the community's savings towards productive purposes. Deposits of banks are classified into 3 categories. Number 1, demand deposits. Number 2, term deposits. Number 3, hybrid deposits. Let's take a look at each of these deposits in detail. Demand deposits. Demand deposits that are repayable on the customer's demand. These comprise the following: current account deposits, savings bank deposits, call deposits. Term deposits. Term deposits that are repayable on maturity dates as agreed between the customers and the bank. These comprise the following: fixed deposits, recurring deposits. Hybrid deposits or flexi deposits, which combine features of demand and term deposits. Lately, these deposits have been introduced by some banks to satisfy the customer's financial needs and convenience and are known by different names in different banks. Current accounts. Current accounts constitute a large portion of demand deposits of a bank. Current accounts can be opened by individuals, business entities, institutions, government bodies, departments, societies, trusts, etc. Savings bank accounts are meant for individuals and small businesses to keep their savings for meeting their future monetary needs. Banks give interest on these accounts with a view to encourage saving habits. Savings accounts can be opened by individuals, clubs, associations, trusts, etc. Fixed deposits are repayable on the maturity date along with the interest at an agreed rate for the period. No operations are allowed to be performed by the customer against the deposit as it is permitted in demand deposits. The depositor forgoes liquidity on the deposit. This gives freedom and opportunities to the bank to deploy such funds for loans or advances and earn interest. Recurring deposits. In recurring deposit accounts, certain amount of savings are required to be compulsorily deposited at specific intervals for a specific period. These are intended to inculcate regular and compulsory savings habit among the low or middle income group people for meeting their specific future needs. Here's a question for you. Which one of the following deposits are repayable on maturity dates? Is it hybrid? Moving on to our next objective, negotiable instruments and related matters. The common features of negotiable instruments are as follows. A negotiable instrument can be transferred by delivery or by endorsement and delivery, depending on whether it is payable to the bearer or order. The holder of negotiable instrument can sue in his own name and can recover the amount of the instrument from the party liable to pay thereon, as there is a right of action attached to the instrument itself. A negotiable instrument confers an absolute and valid title on the transferee who takes it in good faith for value and without notice of the defect in the title of the transferor. Bills of exchange. The main elements of bills of exchange are as follows. A bill of exchange is used in business and trade involving the seller and buyer of goods or services sold on credit terms. It has three parties: drawer, which is the seller; drawee, which is the buyer; and payee, which is the beneficiary. Instead of paying cash, the buyer undertakes to pay to the payee or to his order a specified sum on demand. The drawee of a bill is not liable until he accepts the bill, indicating there his assent to the drawer's order to pay. The date of payment must be certain or ascertainable. Demand bill is payable on demand or immediately on presentment. Like a bill of exchange, a check also has three parties. The drawer is the account holder signing the check, the drawee is always the bank, and the payee is the beneficiary who will receive the amount mentioned in the check. Here are the features of a check: in written format, form of check, drawer signature, date of check, amount on check. All the common features of negotiable instruments are: instrument has to be in writing. The instrument must contain an unconditional promise or undertaking. The promise must relate to paying a certain sum of money and not anything else. The payee must be a certain person, either singly or jointly. The instrument must bear the signature of the drawer or promisor. Other negotiable instruments include banker's drafts, traveler's checks, dividend or interest warrants. Let's take a look at each of these in detail. Banker's drafts. A banker's draft is a payment order issued by one branch of a bank upon the other branch, instructing the drawee branch to pay the specified sum of money to the specified person or to his or her order. Traveler's checks. Some banks issue traveler's checks on commission basis to enable the purchasers a safe substitute to cash while they are traveling, thus are mitigating the risk of loss. Traveler's checks are in the form of pay order drawn by the issuing bank or the organization on itself. Dividend or interest warrants. A dividend or interest warrant is used for payment of a dividend or an interest by a company or organization to a person holding shares or bond through a bank. Here's a question for you. While issuing a check, which of the following party is always the bank? Drawer, deposit. Moving on to our next objective, loans and advances. Importance of lending. Lending is also a very important function of a bank. Funds mobilized from deposits are deployed by banks in making loans and advances to various businesses, trade and commerce. The main purpose of loans and advances is to earn profit by the way of interest spread, that is, the differential between the average interest rates receivable on loans and payable on deposits. Importance of lending. Let us now understand the importance of lending from the following perspective: for the bank, for the development of the economy, for the society. For the bank, loans or advances constitute a major chunk of a bank's assets. These also yield returns by way of interest income, which contributes the largest percentage of a bank's profits. Bank levies interest at period intervals on the funds lent to the borrowers, and the total interest collected during a financial year constitutes a major portion of its gross interest income. For the development of the economy, by lending the depositors money to the borrowers, banks help the latter in setting up and expanding businesses and trade in the country, thereby contributing to its economic development. Without bank loans, the country's industry, trade and commerce will languish and tend to stagnate or grow very slowly. For the society, banks' lending function helps the society indirectly through employment and income generation, which increases as the economy develops. Banks, as responsive corporate citizens, plow back a portion of their profits in community welfare activities. The principles of lending are safety and security principle, risk diversification principle, profitability principle, liquidity principle, loan purpose principle. Fund-based credit facilities. These involve outlay of funds for working capital requirements by way of cash credit, overdraft, demand loan, bill discount or purchase, capital expenditure or project requirements by way of term loan, project finance, deferred payment, guarantee. Non-fund-based credit facilities. These do not involve outlay of funds and are fee-based. These include letters of credit, bank guarantee. Classification of assets. Assets of a bank can be classified into two categories. They are number 1, performing assets, number 2, non-performing assets. Let's understand both of these in detail. Number 1, performing assets. These are represented by borrowal accounts, which are regular in repayment of stipulated installments and interest or in order, and the bank is able to realize interest thereon as and when it becomes due. Simply put, these are healthy accounts conducted by the borrower as per the sanctioned terms and yield regular interest income to the bank. Number 2, non-performing assets. If a borrowal account remains irregular or out of order during a period prescribed by the regulatory authority, it is classified as non-performing asset. These assets can be classified into 3 subgroups. They are substandard asset, doubtful asset, and loss asset. Next objective in the course is fee-based banking services. Unlike fund-based services, fee-based services do not require any outlay of funds by the banks, nor do these involve any risk on the part of banks. In fee-based services, banks essentially utilize customer funds by acting as per their instructions or by using their own expertise and infrastructure, branch network, correspondent relations with other banks, skilled human resources, public faith and trust, etc. Categories of fee-based banking services. The bank's ancillary services are classified into 4 categories. Funds remittance or transfer by demand drafts, mail, telegraphic, electronic transfer, collection of checks or bills of exchange, other instruments. Letters of credit and guarantees in favor of third parties as per the customer's requirements. Agency services, correspondent banks services, government business, sale of products of mutual funds, insurance companies, securities, etc. Safe custody of valuables and maintaining safe deposit lockers. Letters of credits and guarantees are quasi-credit facilities and form an integral part of the core lending functions of banks. Kinds of letter of credit. The following are the various kinds of LOC. Revocable LOC, revolving LOC, irrevocable LOC. Kinds of guarantees. The following are the various kinds of guarantees. Financial guarantees, performance guarantees, deferred payment guarantee. Let's move on to our next objective in this course, electronic banking. What is electronic banking? Electronic banking means banking done through electronic systems for customers' transactions and/or internal accounting and bookkeeping instead of using the traditional manual system of banking. Customer service has enhanced considerably in the following ways: introducing new banking channels such as ATMs, internet banking, and telebanking, enhancing customer convenience through initiatives such as anywhere and anytime banking, making routine banking transactions speedier, safe, and secure, achieving integrated banking service through interconnectivity of branches. Automated teller machines or ATMs. An ATM is a cash-rending teller machine. This helps a bank customer to withdraw money from his account without having to go to the bank. An ATM is a user-friendly, computer-driven system which operates 24 hours a day, 7 days a week. A totally menu-driven system which operates 24 hours a day, 7 days a week. Advantages of ATMs: round-the-clock banking for 365 days a year, quick and efficient service, response is uniform and fixed for all customers as per the program set. Mobile banking. Mobile banking tries to reach the customer to enable him or her to transact banking. This can be done in two different ways. Banking through a mobile van, a mobile bank, with or without computerized banking system, an ATM on ship or an airliner. Here are the benefits of mobile banking. Lower capital investment as compared to a brick and mortar bank and larger area coverage. It is a novel concept with the banker visiting the customers for banking. It serves as a tool for marketing on special events. Telebanking. Telebanking requires authorized customers to use a special telephone number of the bank. Telebanking can be done from anywhere at any time. There are two kinds of telebanking. They are public inquiry, private inquiry. Let's look at each of these in detail. Public inquiry. General information about banking services or facilities can be obtained by customers and non-customers alike by dialing a special inquiry number of the bank call center, and the desired information can be obtained after reaching the concerned extension number or desk. Private inquiry. This relates to account-specific information and can be accessed only by the account holder by disclosing his or her secret personal identification number, PIN, and customer ID. Internet banking. Internet banking means online banking from home or anywhere. It provides anywhere, anytime banking access to one's account as well as to the public information updated by the bank on its website. Our next objective is marketing of bank products. Marketing in financial sector. Marketing in the true sense of the word is relatively new to the financial sector. Marketing has developed as a more integrated function within financial service organizations, largely as a result of rapid changes in the operating environment. Marketing remains a relatively recent management function in the financial services sector. Marketing agencies. One of the recent strategies of marketing is through the agency channel known as Direct Marketing Agency, DMA, or Direct Selling Agency, DSA. These agencies carry out function on behalf of the banks and should therefore scrupulously follow product details. The officials or employees of these agencies should be well trained on products and should have a deep understanding of the bank and its functions. Marketing mix. Marketing mix is one of the key concepts in the modern marketing theory. Concept of marketing mix was given due recognition in the field of marketing theory. It is a set of marketing tools that the firm uses to pursue its marketing objectives in the target market. Marketing tools, 4 Ps. It may be noted that the 4 Ps represent the seller's view of the marketing tools available for influencing the buyers. From a buyer's point of view, each marketing tool is designed to deliver a customer benefit. The 4 Ps correspond to the customer's 4 Cs. They are product, place, price, promotion. Marketing tools, 4 Cs. It may be noted that the 4 Ps represent the seller's view of the marketing tools available for influencing the buyers. From a buyer's point of view, each marketing tool is designed to deliver a customer benefit. The 4 Ps correspond to the customer's 4 Cs, and the 4 Cs are consumer, convenience, cost, communication. And now let's move on to the last objective of this course, Know Your Customer, KYC. For KYC policies, a customer is defined as a person or an entity that maintains an account with the bank, one on whose behalf the account is maintained, beneficiaries of transactions conducted by professional intermediaries like stockbrokers, solicitors, etc., as permitted under law, any person or entity connected with a financial transaction which can pose significant reputation or other risks to the bank. Here are the guidelines on KYC. The government and the central bank expects all banks to have comprehensive KYC policies. These policies should be on key areas mentioned below: customer acceptance policy, customer identification process, monitoring of customer transactions, risk management. Transaction profile. Compilation of a customer's transaction profile is important as it is critical to the identification of fraudulent or suspicious transactions. A transaction profile is a matrix of different components like source of funds, level of income, volume and frequency of transactions, origin and destination of funds, etc. Let us now practice all that you have learned about managing a sales team with success. Visit the bank which is near your home or office, and you're required to do the following. Find out the interest rate for personal account which the bank pays. Find out the interest charged by the bank for personal loan and housing loans. Analyze the difference between the interest rates paid by the bank for term deposits, demand deposits, and recurring deposits. George has recently joined as the branch head of Global Commercial Bank. His bank has introduced new financial products, and there are more fraudulent transactions happening in that branch. How should George market the new financial products to its customers? What steps should George take to put an end to all the fraudulent transactions? Here's a summary. Functions of a bank can be classified as traditional functions and modern functions. Merchant banking involves disintermediation, as it helps savers to invest directly in the shares of the companies instead of depositing their savings with the banks. CRR, SLR, bank rate, OMO, SCC are considered as tools of monetary control. A customer is a person who has some sort of account, either deposit or current account, or some similar relation with the bank, and from this it follows that any person may become a customer by opening a deposit or a current account or having some similar relation with the bank. The duties of a bank can be categorized into two categories: duty of secrecy and duty of reasonable care. Any person who is competent to contract can open a deposit account with a bank branch of his or her choice and convenience. Hybrid deposits or flexi deposits, which combine features of demand and term deposits. Bill of exchange is used in business and trade involving the seller and buyer of goods or services sold on credit terms. Funds mobilized from deposits are deployed by banks in making loans and advances to various businesses, trade and commerce. Letters of credits and guarantees are quasi-credit facilities and form an integral part of the core lending functions of the banks. Telebanking requires authorized customers to use a special telephone number of the bank. Telebanking can be done from anywhere at any time. Compilation of a customer's transaction profile is important, as it is critical to the identification of fraudulent or suspicious transactions. Here's a glossary. B. B stands for bank. The word bank means an organization where people and businesses can invest or borrow money, change it to foreign currency, etc. M. M stands for merchant banking, which refers to dealing with the securities on fee basis without outlay of funds to the clients. It also means modern banking, which is about providing an array of services to customers under one roof so as to enable banking with convenience. D stands for demand deposits that are repayable on customers' demand. These comprise the following: current account deposits, savings banks deposits, call deposits. D also stands for dividend warrants. A dividend or interest warrant is used for payment of a dividend or interest by a company or an organization to a person holding shares or bonds through a bank. A. A stands for assets of a bank. Assets of a bank can be classified into two categories. They are performing assets, non-performing assets. E stands for electronic banking, which means banking is done through electronic systems for customer transactions and or internal accounting and bookkeeping instead of using the traditional manual system of banking. Congratulations! You have successfully completed the course on basics of banking.
طيب دلوقتي هيكون عندنا بريك قصير 10 دقايق بالظبط، فخلينا بعد 10 دقايق نكون موجودين في الميعاد عشان نكمل بقية الكورس. Thank you. طيب welcome back. دلوقتي هنكون بنتفرج سوا على تاني فيديو، وتاني فيديو ده هيكون بيكلمنا اكتر عن ايه الخدمات اللي البنك بيقدمها للافراد. فكتير قوي بنسمع عن مصطلحات زي مثلا الحسابات والقروض والودايع. فالفيديو ده هنكون بنتعرف فيه اكتر على كل الخدمات دي، وهنكون بنتعرف اكتر ازاي بتفيد حياة الافراد. خلونا نتفرج عليه سوا.
Welcome. I want us in this course to examine like a high-level overview. We'll go into some details of what retail banking is in the financial services space. I know many of us engage with retail banking when we go to the bank branch or when we're using our card or paying a bill, or some of us have loans or overdrafts. Some of us have also some other products that we use within our retail banks. Some have savings accounts and we have current accounts and so on. We're charged fees sometimes. And some people, you can go to your branch and talk to your branch manager and sometimes you use them on an app and so on. The idea is to just break some of this down to help segregate and describe in greater detail what the responsibilities, what the products, what the services, what the uses of a retail banking service or business could be, what they're meant to do, how they do it, what products they offer, who they engage with, what kind of terms they provide, and how you can engage with them in a way that is beneficial, or at least understand what they're meant to be doing. And so put together this course so you can understand some of the products, some of the services, some of the transactions, some of the compliance things or areas they need to focus on, they need to cover to facilitate and ensure that they're meeting their responsibility, and you can get the best out of your interaction with them, and you can learn more, especially if you're in the financial services space or the accounting space. See you on the inside of the course. What is retail banking? Retail banking relates to services provided to individual customers in particular. Retail, by the nature of that word, means individual, or means small scale, or means at a soul level, at an individual level. Some of these services include savings accounts, deposit accounts, credit cards, mortgages, current accounts, and so on. Retail banking focuses on trying to solve financial services or provide financial services solutions that relate to the personal needs of individuals, that relate more to the individual, their families, or their children, like paying school fees, like paying electricity bill, or telephone bills and things of that nature. It relates to helping individuals access financial services. And there's so many examples all over the place. Some examples include Barclays, HSBC, ICICI, JP Morgan Chase, Wells Fargo, and many, many, many more banks that offer retail banking services. They offer all these banks offer checking accounts or current accounts, as they're called sometimes, savings accounts. And we'll look a bit deeper into the difference between some of these products and services in subsequent chapters. So generally, retail banks are what you probably are interacting with or engaging with on a regular basis, except if you're operating through your business. It's probably where salaries get paid into, and you take expenses for the month out, like paying your rent and so on. Retail banking structure. Most retail banks operate as a network, if under the umbrella of a larger organization, or joint networks to facilitate many, many things. So they are standalone businesses in general, but where they fit into the wider financial services sector is that they deal with the individual. So you'd have other types of services being provided, sometimes within the same organization, most times, that are like business focused or corporate focused. Usually they call them business banking or corporate banking. You have other services like stock brokerage that are within a big wide organization. Sometimes you have investment banking and advisory type services, which is more for wider, which is for big organizations and analysis, companies selling one another, and other type complicated and complex structures. You have M&A, mergers and acquisitions. You have so many different segments to the financial services sector, but the retail banking structure is a standalone business usually, but normally they work within a network or connected to other businesses. So it could be a branch or an app these days that you find that's connected to a bigger network or head office, for instance, that operates locally in a particular jurisdiction or environment. And some of the things that why they do that is to increase the range of products and services they can offer to those locally. so they can tap into the head office network or they can tap into a wider network. The speed is because they can see people one-on-one, multi-location presence, like we've mentioned, the ease of customer access and economies of scale, where they can gather things together and get the benefit of buying a large. So let's look at some of the key features of retail banking business. They're usually like branches or subsidiaries or connected to a wider network of branches and subsidiaries reporting to a head office. One look at the individual one. They're sometimes operated out of a building and or online. So effectively, they have a branch manager, they have cashiers, a counter, they have a business manager and other officials that are present in that branch who attend to the various needs of the customers. In the previous chapter, we spoke about how they are close to the local local community so they can understand what the requirements are. All the people present in a branch usually in retail banking are there to facilitate financial services solutions to all the people that are coming in. Remember, we're dealing with individuals. And so you have the branch manager, you have the cashier, you have business managers, you have those that are dealing with credit, people that want loans, those that do mortgages, and so on and so on. Customers, they have customers come in, contact them directly. And for those that are online now, usually part of a wider, bigger network or bigger business, they can probably book appointments through the online app at their local branches, so someone can actually either call them back or they can go in to see someone, maybe to present some documentation. So again, they serve individuals. Products, retail offers savings accounts, they offer current accounts. We'll look at some of those products and services in subsequent chapters, where we look at the various types of products that are provided through your retail banking business or retail banking branch of financial services. The scale. Retail deals with smaller transactions. So you can have people going into the bank to get out £10 or $10 from the bank from the ATM machine. You can have them going to the counter to pay $10 or to get $10 or to get the money converted into smaller change or to pay in some money they want deposited into their bank. And it doesn't have to be big, it can be small amounts. A real life example, HSBC is retail and provides mortgages. Like I said earlier on the branch, you have the officers, you book an appointment with a mortgage officer in the branch and they will sit with you and discuss your requirements and hopefully come up with a solution for you. So these are some of the features of retail banking business in your local branch where it's still physical presence or online where it's been integrated into the more modern platform. Here are some examples of retail banks. Retail branch of a larger bank. So sometimes you have big banks that have various segments, have various divisions, and have a retail division that is operating either on the high street or close to the individual customer. We know of many examples here in the UK. You have the HSBC, you have Barclays, you have NatWest, and so many others. They will be very different where you are, but the idea is they're dealing with the individual and they have branches close to the town center or in a populated area or where there's a lot of business or commerce where individuals can go in and transact, given some of the things that we'll be discussing in this course. Community banks, these are some of the banks that are set up by the community. Some are government linked or adjacent or set up by various groups, maybe a union or labor union of some sort, or groups of particular people, maybe farmers and so on. So you have those different types of community banks serving a particular location, jurisdiction, trying to ensure that some of the services that retail banks offer are made available to as many people as possible. Savings or credit union. So sometimes you have a savings bank or credit union where they encourage people to save, to put deposits, which are discussed extensively in this course, and where people can go and put their cash or deposit a check. And sometimes when they need money, they can then get some kind of credit from this because they are part of that particular bank. Again, they can be connected to a wider network, or could just be the standalone individual business. Building societies. These are retail banks specifically aimed at people trying to buy a house or trying to secure a mortgage or pay off a mortgage, and they're usually bundled with savings and other deposit activities, as we discussed in the course. There are quite a few examples all over the world, and the idea is directed at helping individuals to be able to buy properties. They're usually called building societies, where people come together and create the deposit side of it, and they're able to get mortgages. Cooperative banks. Cooperative banks are similar to the example we used earlier on. Maybe farmers group comes together, a union comes together, where different people cooperate, and they're usually small, but they're large ones as well. So these are examples of retail banks that you might find near you. Welcome. Let's look at some of the products and services in the retail banking sector of the financial services industry. Savings accounts where customers deposit money and earn interest. There are various types of savings accounts. They depend on duration, depend on the amount you put in, depend on how much you can access the funds, and depends on how much interest you agree with the bank, and so many other things. Mortgages. Loans for purchasing homes mainly, repaid over time with interest. Credit cards. These are cards allowing customers to borrow funds up to a limit, which they have to repay on a monthly basis or agreed period, but have a certain amount they need to repay on a regular basis, and going over that amount or not repaying that amount usually attracts a high level of interest. Insurance products. Policies covering life, health, and property risks. Your retail bank can sell you all these products and many more, and sometimes they bundle it with accounts, sometimes they bundle it or they propose it to you when you go into the bank for other transactions that they believe an insurance product might be useful for. Overdraft facilities, short-term borrowing linked to a checking account. So normally in the current or checking account, you have a certain amount of money that you put in that you can spend every month, maybe from your salary or some other kind of income. An overdraft allows you to spend beyond that. So let's say you earn $1,000 or pounds every month. You can agree with your bank, depending on your credit rating and depending on your whatever conversations you're having with them, or an application usually goes in to say, can you please give me an overdraft, which means you can overdraw beyond what you have in the account. So let's say you have $1,000 or pounds coming in, you could draw. They could give you an overdraft up to 300 maybe, and so you can extract or withdraw more than 300 above what you have. They charge you a fee over time. Digital banking services. Most retail banking companies or businesses provide some kind of digital interface these days. These are online and mobile platforms for banking activities, where you can do many of these things we're discussing here on your app or online on your computer, make applications, contact the bank, look at your bank balances, and so on and so forth. Checking or current accounts. As we mentioned before, checking or current accounts are accounts where you don't necessarily attract interest. In fact, some current accounts charge you a fee for that service, but a lot of your payments are scheduled through there, and you receive money in there, such as your salary or some other kind of payment. Accounts for daily transactions with no interest, used to set up regular expenses as outgoing payments. For instance, standing orders or direct debits, and used to receive things like salaries and wages and so on. Personal loans, unsecured loans for personal expenses such as car purchases and repaying other loans. So sometimes they give you a loan to repay other loans and bundle them together into one and make the payment more easier, seamless through one channel, through your retail bank. Wealth management, where people who are customers of a retail bank have significant sums of money retained there. Normally they'll propose you speak to someone who can manage your wealth, help you decide how to invest it, or get the best out of it. Advisory services for high net worth individuals. Usually that comes to the retail banking segment as well. Foreign exchange services for currency exchange for travel or remittances. If you want to travel, you go into your local retail bank, they change it for you. And sometimes they offer discounts and other benefits of banking, including shopping, volume discounts or vouchers, travel opportunities, and other benefits through partnerships with other providers through your retail bank. This is a new thing, or new in the last maybe 10 years, where retail banks, because they get a lot of customers, utilize that access they have to people to try to sell them or get them to provide other services to these customers, selling these third-party services, such as the ones we've mentioned. And it gives a benefit and advantage because then the customers can pay through the retail bank. Customers can also utilize the services through the retail bank, and sometimes they will provide things like customer service and support for some of these things through the retail bank. And sometimes it's based on what the customer is already doing. So let's say you use a checking account, you reach a certain volume, you might be in a particular shop or store, you might get a discount from that, which hitherto you wouldn't have. See in the next chapter. Welcome. So deposit accounts. So in general, we want to talk about deposit accounts as a principle, as a concept. A deposit account is a bank account that allows money to be deposited and withdrawn by the account holder. These include savings accounts, current accounts, and fixed deposit accounts. So there are different types of accounts. This is sort of to differentiate them against things like credit facilities, like loans or credit cards, or differentiate services, other services provided by retail banks, such as currency conversions or other services or insurance sales services and things of that nature. The various types and features include savings accounts for regular savings, earning interest, and so on, that we discussed in the previously, and further still in this course. Current account for business transactions and also for people with collecting or earning salary or wages, so that can be paid into that, and that is called a deposit. It usually doesn't earn an interest. In some cases, you pay a fee. Fixed deposit or time deposit account, locked for a fixed term at high interest. Recurring deposit account, which fixed monthly deposit, fixed tenure, and steady interest. So effectively like a fixed or time deposit, but it's recurring. So you pay maybe monthly or quarterly, and depending on your agreement with the bank. And the features include accessibility. Some accounts allow frequent transactions. So you put your money in the bank as a deposit, and accessibility matters because then you need to get it out. You need to spend it, you need to allocate it to use it correctly. Interest rates vary based on account type, as mentioned previously, and security of funds, as we mentioned in another module, and we'll look at that in another chapter. We'll talk about your protection of your deposits, statement and online tracking these days. So statement, you can go into a retail bank, a physical branch, and get a statement if you want one. You provide some ID and some account details, and also just log into your online. That is one of the services provided by your bank. An example is a couple opens a 2-year fixed deposit account for 20,000 rupees at 6.5% annual interest and earns 26,000 rupees over that term. That is a deposit account because they went in and they deposited money in the account, as opposed to other types of accounts that don't require that, as explained in this module. See you in the next chapter. Let's take a closer look at retail banking products. I know we went through some of them in the previous chapter, and we went through them quite quickly. I want us to be a bit more detailed in our understanding of some of these products. Savings accounts. A savings account is a form of deposit account held at a bank or financial institution that earns interest over time. So you put some money in the bank and they pay you interest over time, depending on what's been agreed with you. It is primarily designed to encourage individuals. That's something we need to note, because we're talking about retail banking. We deal with mainly individuals to save money securely while earning modest returns. It could be something as small as $100, $5, $10. Usually savings accounts, depending on the kind of savings account which we'll come to, you can actually put some money into it on a regular basis. Some maybe not so regular. Some don't have upper limits and others, or lower limits, some do. So various types of savings accounts and features. Let's have a look at those. Regular savings accounts. It's a low minimum balance. Like I just mentioned, you can put $5 into it, $10 or pounds or whatever your currency is where you are. This earns interest monthly and ideal for everyday savers. So let's say you want to put some money away every day, you can use that. High yield savings accounts. They're called different things in different jurisdictions by different banks. They will have a product name and some really fancy names that are used by banks to promote and to market these services. So it could be called something else, but these are the features, and you can actually look at what the account actually does. Offers high interest rates, usually with online banks. So there's some online banks that will, to attract customers, given that they're sort of new to the scene, they offer very, very high interest rates, so they're high yield savings accounts. But also other traditional banks or the legacy banks offer these as well. Fixed or term deposit accounts. So fixed or term deposit account is what it says, fixed or term. Locks in funds for a fixed term with high interest. So sometimes they say, put your funds with us. Usually they have a minimum, maybe $1,000, $10,000, whatever the minimum is, and they will say, but you have to live it with us for 3 months, and you can't break that. And therefore, because then the bank will utilize it for business and return it to you with a higher amount of interest because you've left it for that long. Money market account. Now, this is where there's more significant funds and varies from country to country, from bank to bank, and from jurisdiction to jurisdiction. So the money market account combines savings and limited check-in features with much better interest. So this is for people with significant amounts of money that are still within the retail banking sector. Children or student savings accounts. So some banks have children accounts where children are born. They can open an account for them, like a savings account, but they can use them sometimes student savings accounts. So parents can pay me things like school fees, or if the students have any change or any kind of small amount of money they want to put there, they can put that away and they'll earn some interest. Tailored for young savers, often with incentives and usually no fees. The features include interest earnings, compound or simple, as discussed previously. Withdrawal limits, sometimes you can't access it all the time, as discussed, for example, in a fixed and term deposit account. Mobile and online access. These days, we all have access to mobile and online government deposit scheme protection or insurance coverage. We'll cover another chapter where your money in the bank to a certain amount is protected by government policy that your bank normally pays for. You don't have to worry about it except to know what the upper limit is. Wherever you are, usually, or most countries, the banks have some kind of protection on the amount of money you have in there, but there's an upper limit. It's in the United Kingdom, it's about £85,000 per account that you have. So if you have a savings account and you have £5,000 in it or less, if something happens to the bank, you couldn't get your money, that insurance deposit scheme will protect you, and over time they'll pay that back to you. If it's more than that, you might not get that back, but it's per account. So you might have several accounts, that's the limit. An example, Sarah opens a high yield savings account with an online bank offering 4% APY, annual payment per year, where she deposits $5,000. Over a year, she earns $5,000. Over a year, she earns $200 in interest, securely growing her savings. Welcome. Current accounts and overdrafts. I bundled them in because overdrafts are usually tied in with current accounts and no other kind of account. So just mention them briefly. Current account, a type of deposit account meant for frequent transactions. It offers unlimited transactions, but usually does not earn interest. So we previously discussed savings accounts and other kind of deposit accounts. And in some of those cases, when you put your money in there, whether it's by your wages or your salary, or you take money to the bank or you transfer it online or however the money gets into the bank, normally they will pay you an interest for depositing your funds with them. When a current account, you're not paid an interest for that because it's used for frequent transactions. So to pay your bills, you go out for dinner or you go to buy groceries, you usually have a card attached to it that you can use to spend it. like a debit card of some sort that you use to allocate what's in your account, and that goes out to the retailer who you bought from, and so on. So those are some of the features of a current account. We'll look at them in a bit more detail later. Overdraft, a credit facility attached to a current account, following account holders or allowing account holders to withdraw more than the account balance to an agreed limit. This is an agreed line of credit and attracts interest. So, like I've mentioned, let's say you get a salary paid into your account and it's about $5,000, but you need to spend more that month. You can agree with your bank, and if they agree, you make an application. If that is approved, then they can increase your limit amount you can spend beyond that $5,000. That's called an overdraft. And types of current accounts and some of their features. The standard current account. Now, these will vary depending on where you are, being in the bank and the jurisdiction and the location and so on, the regulation as well. The standard current account. For individuals with regular transactions, regular outgoing payments, there's really nothing much to that account. It enables you to set up direct debits and standing orders and use your card to make payments and so on, and receive money in. Premium current account comes with added features such as insurance, such as like life insurance. I've seen some that come with things like life insurance or car breakdown cover, and usually come with a higher overdraft limit. Package current account includes bundling services such as travel benefits or legal advice. So if something goes wrong, or you need legal advice, they can actually procure that through a panel of legal suppliers or solicitors or lawyers for you. Or like travel benefits, sometimes the travel companies, like the airlines, make offers and say to the bank saying, if you have very good customers who keep up with their payments, we'd like to work with you, as in the travel airline or the airlines work with the bank to provide a discount of some sort. And they'd like to attract your customer, attract your money to them by doing that. The benefit to the bank is more of your money comes through them, and they like that. The features include unlimited deposits and withdrawals, check-in facilities. You can write a paper check, as in almost say, this person, I need to pay someone, and you write a check. You write a note on a pre-printed approved check, and that person presents in their bank, and they take the money from your bank. Overdraft protection, monthly and quarterly fees. We're talking about overdraft, monthly and quarterly fees sometimes, setting up automatic outgoing payments such as bills and standing orders and direct debits. An example is an individual opens a standard current account to manage their regular bill payments. See you in the next chapter. Welcome. One of the key products that are provided through retail banks are home mortgages. Home mortgages are supposed to commercial mortgages and office mortgages and so on. This is specifically tailored to the individual, as we're talking about retail banking products here. A residential mortgage is a loan provided by a financial institution to help individuals purchase residential property. The property acts as collateral, and the borrower pays the loan with an interest over an agreed period, usually between 15 to 30 years. Sometimes it's shorter. Nowadays, I hear there are longer types of mortgages out. 55 years, I've been told. So effectively, you want to buy a house, you identify the property, you go see it. At least that's how it happens in some jurisdictions. And they tell you the house is X amount. You then need to put down a deposit, some kind of commitment towards the amount, and hopefully you are able to get a home mortgage. And you can walk into your retail bank or walk into any retail bank and say, I'd like a mortgage. They usually have a mortgage desk, a mortgage officer that will deal with it. They'll put an application through. They'll come back to you with offers if you're able to get it, or whatever decision has been made, either through their mortgage department or through another provider that's working with them. So the features include secured loan against the property. So the security of that amount, because usually a huge sum when we're buying houses these days, the security, why they would give me a huge sum of $100,000 and I've only put down $5,000 or $10,000 as my deposit to secure that $90,000 they've parted with for me to buy the property, which I'll repay over 15 to 30 years, is because that loan is secured against the property. If something goes wrong, they do evaluation of the property. They check to make sure there's nothing wrong, and so things of that nature, and then they determine how much they are able to extend to you. So that loan is secured against the property. Secured loan against the property is fixed or variable interest rate. So the interest rate you pay, because you pay an interest rate on that. If we carry on with the example, 90,000, I went to the bank to secure to buy 100,000 property. There's an interest rate because then that's their income. It can be fixed. It can say pay this over the next 3 to 5 years or 10 years or 1 year, whatever the duration is. It can be fixed or it can be variable depending on what the banking regulators are doing. Long-term repayment period, like we discussed, can be up to 10, 15, 20, 30, now even more than that. Monthly repayments, principal plus interest. There is principal only sometimes. There's principal plus interest. There's interest only sometimes, or used to be, and then there's principal plus interest. The idea is for you to be able to pay off the whole amount you owe plus the interest over the period agreed. Requires down payments and good credit history, as discussed before. You require some kind of deposit, some kind of down payment, and includes terms for foreclosure in case of non-payment. So they'll tell you, if we don't receive money from you after a while, and then we might need to go to court, and the judge would then say you need to return the house to the bank or things of that nature. An example is John purchases a home worth $300,000. He pays a 20% down payment, which is $60,000, and borrows the remaining $240,000 from a bank as a mortgage to be repaid over 25 years at a fixed 4% interest rate. And that example explains all the various aspects we went through. See in the next chapter. Welcome. Personal loans and credit cards. I've tried to bundle some of the credit facilities together for retail banking available to the individual, so we can go through them with the same. There are similar areas where they overlap, and there are areas where they're very different. So we'll go through them and try to understand them a bit better. A personal loan is an unsecured loan given to individuals based on their credit worthiness, typically used for personal expenses. So an individual wants to, for instance, buy a car, or they need a loan for different things. So they want to aggregate all the loans together and put them in one place, and maybe they get a better interest rate from their bank rather than when they have loans elsewhere. That also is one way people use personal loans. A credit card is a revolving line of credit that allows users to borrow up to a set limit and repay with interest if not paid in full monthly. So you get a card that gives you access to credit, which you can use to spend and cover your expenses for the month, travel costs, groceries, or purchase clothes, do perfume, do whatever you want to. You can buy a car, do different things, and it's a credit. It's done on credit, and you're meant to repay at a set period, usually the following month. And if you repay all of it, you don't incur too much interest. But if you don't repay all of it, then there's an interest element on the amount that's outstanding. The features include, for personal loans, fixed loan amount and tenure. So usually it's a fixed loan amount and tenure. Pay this loan, you get it for, we'll come to an example, and we'll look at someone who's used it to fund her wedding. Monthly repayment schedule is agreed, and interest rates vary by credit score. How credit worthy are you? The bank determines that, and they say, look, we can give Mr. A X amount at X rate, but we'll give you Mr. B another Y amount at B plus rate, which is higher than what they gave Mr. X. Credit cards. These are flexible borrowing within a credit limit, so you can use the card as much as you want within a particular limit, which is usually the upper limit. Minimum monthly payments allowed, so usually, let's say you have a credit card that has a limit of $1,000, they can tell you the minimum monthly payments would be $30, and you need to pay that every month, and the rest they'll charge you interest on and roll forward to the following month, and so on and so on. Interest charged on unpaid balances, which we just discussed, and rewards and cashback options. Now, a lot of credit cards bundle these in. They give you points, give you rewards, give you cashback options if you shop and use the card in certain places to encourage you to use those cards with certain partners that they have an agreement with, and that is tracked, and you can get discounts and things of that nature. An example is Emma takes out a $10,000 personal loan to fund her wedding, repaying it over 3 years at 10% interest. And that is a personal loan. It's fixed, and she will pay about the same amount every month for 3 years and clear it. Liam uses a credit card to purchase a $500 airline ticket and repays the amount over 2 months, incurring a $15 interest. See you in the next chapter. Retail banking products, insurance. Insurance is a financial product that protects individuals or businesses against risk in exchange for regular premium payments that the person being covered, being protected. An insurer provides compensation for specified losses, damages, illness, or death, depending on the policy. So many of us know about car insurance or home insurance and insurance products of that nature. These can be purchased also through your local bank or through your local retail banking app, because they deal with individuals. Risk coverage for health, life, and property. Here are some of the features of some of these insurance products. Payment premiums, monthly, quarterly, annually. Because if you don't make any payment towards the policy, then the insurance coverage is voided. Effectively, you haven't made the contribution towards your policy in case that thing happens. So you're actually not covered. So that payment is called a premium that you make towards your policy. Policy duration and renewal options is to tell you how long you're covered for, what the renewal options are, deductibles and claim processes, how much you might need to come up with if that risk actually crystallizes, any of the risks mentioned there above, losses and damages, illness and death and so on. Can be individual or group based. Encourages financial security and planning. Sophia buys a health insurance policy covering hospitalization costs up to $100,000 after an emergency surgery costing her $12,000. The insurance reimburses her the eligible amount after deductibles. All these can be done through your local retail banking business. Retail banking products, foreign exchange, forex or FX, or currencies. Foreign exchange or forex refers to the services or service offered by banks that allow customers to buy, sell, or convert currencies for travel, for business, or personal purposes. It supports international transactions and travel by facilitating currency exchange. Retail banks typically offer forex services over the counter or via their ATMs or online banking platforms. So let's say you need another currency. You're paying someone you earn one currency, or you're in a country with one currency. You need to make a payment or need to receive a payment for another currency. If you need to make a payment, you can go to your retail bank or speak to your local banking app provider. These days, it's actually on the software, on the app, where you can make that change or conversion and then send to the person. And if someone needs to make a payment to you and the person is from another currency or from another country which uses another currency, that then can be paid to you as well from a different currency, where your retail bank makes the conversion themselves and sends to you. The features include currency conversion, exchange one currency for another, as we just explained, for example, USD to Euro. Cash and card services, foreign currency available in cash or prepaid travel cards. These days, there are many services that enable you load a different currency onto your card, or use a card wallet, a currency wallet, within your regular debit card account, within your normal retail banking app service provider, to spend when you go to another currency. And we'll look at an example later. International transfers enables you to send money abroad. Like the example I used earlier on, via SWIFT or other payment systems. There are so many payment systems now that facilitate cross-border payments. Fee structures, usually flat fees or commission, or both. It can be hybrid and so on transaction amount. But by law, by regulation, they need to let you know what those fees are. For example, Maria is planning a vacation to the UK, she visits her local bank branch in New York. She's coming from the United States to the UK, and exchanges $1,500 for British pounds. The bank offers her an exchange rate of $1 to 0.75 Great British pounds minus a small service fee. She receives approximately £1,110 in cash and a travel card for convenience. So that's a good example that explains what your retail bank or your retail branch can do and does. Like I say, it's all done on the app these days as well. See you in the next chapter. Here's some other services that are provided by the retail banking segment of financial services, of the financial services industry. Debit cards. The debit card is a card that, as the description says, that you make payment or transactions using a pre-approved issued card by your bank or issuer, where it links to an account where you already have a deposit. So it can link to a savings account, it can link to a current account, it can link to different accounts. This is used to make payments where you don't actually have to go to the bank to get a cash out in particular. So you can specifically to make a payment, so you can show them your debit card and they should have a device that will take the payment from you, and it should link with your account and deduct the amount. This is as opposed to a credit card, which is described earlier on, with some form of rolling credit. So in this case, you have to have a deposited amount with that account holder and the card issuer, or linked to that before you can use it correctly. It's very versatile, can be used globally, and it's something that retail banks use quite a lot these days. In fact, standard these days with most accounts. Online banking. We discussed this and mentioned this, where you can access your account online through a computer, laptop, tablet, or on an app, for instance, where you log in and you have a security protocols that you go through, and all those things will be sent to you by your retail bank and you'll be told how you need to log in and how you need to use it. Sometimes these services go under maintenance and they're not available for a little while, but in general, they're very convenient to use and very useful for you to access your funds, allocate them, make payments, and do things of that nature, and provide those details, your account details, for other people to send funds to you if you need to collect money. Direct debits and standing orders. Direct debits are when you have a merchant and you need to make a payment to them on a regular basis. So they ask you for your details, your bank account details, because they usually have a relationship with the aggregated bank account detail segment of the retail banking segment of the banking industry, and they send an instruction effectively to your bank that you've authorized them to take this amount every month, and then they send some paperwork to you that you need to approve. Standing orders are the ones you initiate yourself, so for those standard regular payments to go out. Then automated teller machines are machines where you have services that are provided by the teller at the till. That's provided by a machine. So you can get your cash out, you can make some payments, you can pay your check in, and so on. See in the next segment. There are a few recent additions to retail banking services to increase the engagement with the customers and also increase engagement with partners and various merchants and other providers, as well as the retail banks. And we're just going to run through some of them here. Discounts, things like bulk discounts, where merchants and discount providers come over to the retail bank or the bank and say, look, if you have a customer that fits this profile, and remember the bank has the information in their system, we'd like to work with them. We'd like to offer them some discounts. We'd like to offer them some benefits. I mean, especially where sometimes you're already making those transactions anyway and not getting anything back on behalf of it. Offers similar to what I just mentioned now. If there's a new launch or a new product on the market, and those merchants or manufacturers or providers provide that to the bank, be people of that hold a certain current account, maybe the premium current accounts that we discussed earlier on. Cashback, similar to that, merchants who reward loyalty from customers of a certain bank or using a certain kind of card debit card to purchase from them and give them advantages for coming back to them. And many other third-party services. We had travel earlier on, where travel companies give you points for using certain bank accounts, and the other way around, where you're able to book flights or get offers on flights or early release insight if you use a particular kind of account in a bank, working in partnership with a third-party airline or travel provider. Let's look at briefly, we're just going to run through some regulation of retail banking in general. We're not going to go into any depth of any of the regulatory authorities or regulatory bodies. We're going to look at them in 3 different jurisdictions: United States, United Kingdom, and India, and just get a flavor to give you comfort that they are regulated, they are actually covered. We'll probably prepare another course in future around and go into detail around the compliance and regulatory side of things in the banking sector. Regulatory framework in the United States. Regulators of note that we can speak about briefly: Federal Reserve, the FDIC, which we covered in a previous segment, the OCC, and others. There's so many others, state by state, region by region, depending on what kind of transactions that people are involved in. These are also, all these have different regulators that ensure compliance. The key regulations that they look after: Dodd-Frank Act and Basel III. Basel III, you will see that transmits as a global agreement that all the banks in all the countries have agreed to execute. The example is Wells Fargo faced penalties for violating customer protection laws some years ago. And just to show you that these services, retail banking services, are being regulated. In the UK, regulators include Bank of England, Financial Conduct Authority, the FCA, Prudential Regulatory Authority, PRA, and many others. The key regulations include ring-fencing rules, where you have to ring-fence your investment banking activities away from your retail banking activities if you're such an institution, and so on. MiFID II, and so many other regulations, the reserve rules, and so many others. An example is Barclays implemented ring-fencing to separate retail and investment banking. The regulatory framework in India includes some regulators like Reserve Bank of India, RBI. Key regulations include Basel III, as mentioned before, Basel III norms, KYC, AML, know your customer, AML, anti-money laundering guidelines that every bank needs to execute to ensure they understand what their customers are doing and they have evidence to back every transaction that goes through their customer accounts. An example is HDFC Bank adheres to RBI's priority sector lending requirements. We also looked at some deposit protection schemes that exist in these 3 countries in another module. See you in the next chapter. Welcome. Let's look at deposit protection schemes. I know we've spoken about deposit accounts, and that's why we took time to try to break them down and go into some of the features. But I just want to explain that sometimes things go wrong. Maybe the banks, and very rarely though, to be honest, statistically, it's very, very rare that the banks are able to meet up to their commitments. When you've deposited your money, you need to access it, and you can't. So there are protection schemes that are there to actually protect you as the individual and protect your deposit up to certain limits, and they operate in a certain way. Most and all banks, or all deposit-taking institutions, as they're called sometimes, actually pay towards a scheme, some form of insurance, so if something goes wrong, you still be able to access your money up to a certain amount. What are they and how do they work? Just explain a little bit how they work. But effectively, they cover deposit accounts mainly. Your savings accounts, the various types we mentioned earlier in the course, your checking and current account, your term and fixed deposit accounts, and so on. All these accounts are covered by this deposit protection schemes that are available in various parts of the world. And like I always say, it varies. The features and the coverage and the requirements vary in depending on the country and the jurisdiction you are in. Loans, mortgages, credit cards, forex, overdrafts, and other things or products that we've discussed as relates to retail banking are not covered. These are not covered in this particular scheme. Only deposits are covered. So accounts that hold and bear deposits that you put money into the bank. Each country has its own deposit protection scheme, and it varies. And the limits and what they do vary from time to time. So this is not a fixed, defined criteria. But in here, we'll put what the current limits are as it applies to various countries and their deposit protection scheme. Every country has a deposit protection scheme. For example, the UK deposit protection scheme is usually called the Financial Services Compensation Scheme, and the maximum limit per account is about £85,000. So if you have more than £85,000 in an account and something goes wrong and you can't access your account, you are probably not going to be protected for the more than that. But the scheme covers, because usually most banks, if not all the banks, are paying to the scheme or get the insurance from the scheme, so you can recover at least £85,000 back. The U.S. Deposit Insurance Scheme, is run by the FDIC, and it covers up to $250,000. In India, it's the Deposit Insurance and Credit Guarantee Commission that runs the scheme, and the compensation scheme covers up to 5 million rupees. So as you can see, it varies, and these can change from time to time depending on the regulation, depending on when you're watching this particular course. But at the time of recording, these are the limits. The conditions are different country by country, and they're administered differently by each regulator. But just to get a flavor, just get an idea of the framework that's in place to protect your deposit when you're dealing with a retail bank, there are deposit protection schemes that protect your funds. See you in the next chapter. Let's take a quick look at future trends in retail banking. There's a shift. A lot of things are happening at the same time in our current world. And there are going to be so many changes, in my opinion. And retail banking, investment banking, and the other segments of banking, the lines might be a bit more blurred. And there'll be that challenge to separate and convince the regulators that each segment of that industry is doing what it should do, as not creating risk for the other in the way they interact. Most retail banks are moving to online platforms, and as it is more accessible, this leads to lower overheads in the long term. Think about it. You create one app or one online website and everybody can go to it, as opposed to having a brick and mortar building where you have loads of people in there. You have to manage them, manage the safety, manage the security, manage the health related type things in terms of people not sleeping over, manage the electricity, heating, water, bathroom facilities, and so on. But the online facility, for the customer, they can sit in their homes and access their services. So more and more businesses and more banks will come to the fore, financial institutions providing retail banking services, in my opinion, going to the future. Many financial technology banks are also operational in most countries now, delivering mostly online services without physical retail branches, like we said. And I think by extension, we're going to see those apps and those fintech solutions begin to utilize data maybe a bit more efficiently, maybe a bit more in a way that they can understand what the customer is doing or wants to do, and potentially utilize that to secure, procure, and work with the customer to get things done quicker, get things done better, more cost-effective way, where the customer is satisfied and earns a lot of value from interacting with the bank. And that takes some thought, that takes some understanding of who the customer is. And also maybe working with vendors, merchants, and solutions providers to help satisfy the needs or requirements of the customer. I think also that there'll be a lot of interaction between various banks, especially the smaller retail bank services that are standalone services. They will join more networks because they will need to access more services that are being demanded by the customer to keep in business. And I'll see you on the next course.
طيب دلوقتي هيكون عندنا بريك ربع ساعة، فبرضه خلينا نكون موجودين في الميعاد.
هطلع أشوف أيسر راحت فين. الربع ساعة هيعدوا أنا أعمل الأكل، بس أنا هسخن الأكل امبارح وخلاص.
تخيل إن زيزو مش عايز يجيب جون، وهوريك كمان الفرق بينه وبين هيثم حسن في كورة جون المنتخب. في الكورة دي زيزو كان يقدر يدوس عليها ويروح في اتجاه الجون انفراد، بس ما عملش كده، وجات له فرصة تانية إن يدوس على الكورة تاني وبرضه ما عملش كده. ده هو قاصد يتطرف بيها مش إنه يروح على الجون. وبعدين ظهر له إمام، كان ممكن يلعب له وإمام يشوط أو إمام يلعبها في قلب منطقة الجزاء، إلا إنه فضل معطل الهجمة وحط كرة صعبة جدا ضيعت الهجمة في الآخر على منتخب مصر. دي كرة شبه كرة الجون، كان يقدر يلعبها لهاني لأن الموقف كان 2-1 لصالح زيزو هاني، وفي نفس الوقت مرموش وتريزيجيه كان هيبقى معاهم وقت يتحركوا في المساحة اللي فضيت في دفاع روسيا.
ويلكم باك لآخر فيديو معانا النهاردة. والفيديو ده هيكون بيتكلم أكتر عن الأوبريشنز بتاعت البنك، إزاي البنك بيشتغل، وهيكلمنا أكتر شوية عن الادخار والاستثمار والتأمين. خلونا نشوفه سوا.
ولاحظ إن المنتخب بيهاجم منطقة الجزاء ب3 لعيبة في مواقف العرضيات، ودي معلومة مهمة. بس زيزو قرر يلعبها هو بدل ما يبصيها وما لحقش لعيبة المنتخب يتحركوا، وطبعا ضاعت الهجمة. شوف بقى كرة الهدف، نفس الموقف 2-1 لصالح هيثم حسن وهاني، بس هيثم لعب مع هاني فده ادى وقت
Finance can be used for businesses examining profits and losses, for individuals making investment decisions, and for everyday choices ranging from banking and buying a house to getting insurance. This means that unlike accounting, which is backward-looking, finance is forward-looking. And that's what this course is all about. In this course, we cover the fundamentals that you need to know to make your life more successful. Let's get started. Understanding how banks work and why they matter to the overall economy is critical. When you understand the role that banks play in your own finances, you'll be better prepared for the future. The basic function of a bank is to accept money from savers opening up savings and checking accounts with the bank, and then loan that money out at a higher rate to borrowers for houses, cars, businesses, etc. It's pretty straightforward, right? Well, banking is more complicated than that, primarily because of 2 factors. First, savers have the right to withdraw their money from the bank at any time, but banks still need to have plenty of money on hand. There's an old story about a man going into the bank during the Great Depression and asking for his money from the bank because he thought the bank was on the verge of collapse. When the bank teller proceeded to bring him his cash, the man looked at it for a minute and said, "Oh, no, you can keep it." The teller looked confused and asked the man what was going on. The man replied that if the bank had his money safe, they should hold on to it. But if they did not have it, then he wanted it all back right now. The point is that the bank, when it's successful, has the confidence of the general public. If the public believes the bank is on the verge of failing, everyone runs to the bank to withdraw their money, which leads to its collapse. It's a self-fulfilling prophecy. To prevent such bank collapses, in modern America, banks are backed by the government. Banks in their modern form cannot exist without the government, which operates both as their biggest depositor and creditor, and their protector of last resort if the public loses confidence in that bank. The second complicating factor for banks is they can't earn enough money to stay in business by just lending out the dollars given to them by savers. Instead, banks borrow money from the government based on the amount of cash savers have entrusted to them. The banks then take these funds from the government and lend them out to the public alongside the money that's deposited by savers. While many people complain about the government's involvement with banks, the reality is that virtually all banks around the world are backed by their respective governments, based on the same 2 factors we've talked about here. For better or for worse, that's simply how the modern banking system operates, both in the US and in most other developed countries. When you're following the news, you might come across an article that the Fed lowered interest rates. It's something the news often reports on. This may be a good opportunity to revisit your finances and make informed changes, such as refinancing your mortgage. That's why understanding the Fed's role in the banking system is important. The Fed not only controls the banks and ensures the health of the U.S. financial system, but it also sets interest rates, which help determine the level of economic growth, inflation, and unemployment across the country. In case you're not sure what interest rates are, interest rates determine the cost to borrow money. When you borrow money from a bank or use a credit card, interest rates determine how much you have to repay the organization. The chairman of the Federal Reserve heads up the Fed's controlling body called the Bank of Governors and acts as the public leader of an organization that most Americans don't really understand, but which all Americans are influenced by. The chairman of the Federal Reserve is often referred to as the second most powerful person in the country, behind only the president, who is the one that appoints the chairman. Today, Jerome Powell is the chairman. The primary tool the Fed uses to set interest rates is called open market operations. Open market operations, or OMOs, are the purchase and sale of securities in the open market by a central bank. Basically, the Fed buys and sells U.S. government debt when they set the interest rates where they want them to be. If you'd like to learn more about the Fed, their website, federalreserve.gov, is a great place to start. Now, you may be wondering how banks make money if they're always borrowing money from the Fed. In order for a bank to make money, the bank must charge more for the money it loans out to people than what it pays on the money it accepts from savers in the Federal Reserve. For instance, a bank might lend money at 5%, but borrow money from the Fed at 2%. The difference between these two is the bank's profit, also called the net interest margin. When you're borrowing from the bank, it's important to consider two significant rates: the prime rate and that net interest margin. The net interest margin is made up by the difference between what the bank charges and what it pays, and it's a critical variable that drives the bank's profit levels. The prime rate is the lowest rate that the bank charges its very best customers. The prime rate and the bank's net interest margin rates drive all of the other rates the bank charges, including CDs, home loans, student loans, savings, HELOCs, etc. Let me show you a real-world example. I'm here at the website for a regional bank that I'm familiar with called Webster Bank. Now, Webster Bank's website, of course, is unique to them, but most banks have a website that's similar to this. But if you go check out your bank's website, you should find areas where they'll tell you about the rates that they pay on things like savings accounts. In the case of Webster Bank right now, Webster Bank is paying rates of as much as 0.3% per year. That's what the APY means. That's the annual percentage yield, which is essentially just the rate of return or rate of interest on your money. So remember that 0.3%. That's what Webster will pay you. Now, if you borrow money from Webster, how much do you pay? Well, if we go over to the Borrow tab, we'll just look at a fixed rate mortgage for, say, a home. In this case, Webster will charge you 3.96%, just under 4% for, say, a standard 30-year fixed mortgage. Now, of course, this will vary based on a variety of factors, but it gives you a good idea of what I'm talking about. Webster is charging you more for money you borrow from them than they will pay you if you lend money to them by opening up a savings account. That's how a bank like Webster and every other bank out there makes money. Now, it's important to distinguish between this APR shown at the end versus what's called a simple interest rate. The APR stands for annual percentage rate. Essentially, it means that you are charged money based on not only the amount that you've borrowed, but any interest that accrues over time. If you fail to pay off your loan, your payments will be higher in the future. It's the compounding effect in your interest rate. The same thing holds true on the savings side. The more money you have as a result of interest payments you've earned in the past, the more money you'll earn in the future. And that's how banks operate. Now you should have a good handle on what you need to consider. Make sure you're making the right choice for the product and rate that is right for your particular needs. CDs are a critical product for the U.S. banking system. No, I'm not referring to the old plastic discs that held music. Instead, I'm talking about a product called a certificate of deposit, or CD, as it's commonly referred to. CDs act like savings accounts, but they pay a much higher interest rate because the person giving their money to the bank promises not to withdraw their money for a certain amount of time in the future. This is often somewhere between 6 months up to maybe 5 years. The longer the term that the person locks their money up for, the higher the interest rate that they receive. Best of all, CDs are guaranteed by the bank, which in turn is backed by the federal government for up to $250,000 per account. Since the government can print all of the green pieces of paper at once, this essentially means that CDs are risk-free as an investment. Let's talk about the pros and cons. CDs offer a higher rate of interest than a savings account. They're guaranteed by the bank and by extension then the federal government. You know exactly what you will receive in interest on your investment. But they also have drawbacks. You are locking your money up for a specific predetermined length of time and can be hard to get that money back without paying a penalty. Moreover, interest on the CD is taxed at ordinary income rates rather than the lower rates that apply to many stock and bond investments. Now, let's take a look at an example in the real world of some CDs. I'm here at the Wells Fargo website, a bank that you may be familiar with. They're a large national bank. This is just an example, of course, but this is a listing of all of Wells Fargo's CDs. Oftentimes, CD rates will vary by location, so these rates, even for Wells Fargo, may be different depending on where you are, and of course, the rates are going to change over time, so it'll depend on when you look at the site. But what this shows is that Wells Fargo has a variety of different types of CDs. Fixed rate CDs, offering a single interest rate over time. Step rate CDs, offering interest rates that change over time. If we look at these fixed rate CDs, you'll see that depending on the time frame that we lock our money up for, we get a different interest rate. Now, normally, under most conditions, you get a higher interest rate as you lock your money up for longer periods of time. That's because the bank is guaranteed that they can keep your money for a longer period without you withdrawing it. In the case of Wells Fargo, because of their expectations about where interest rates are going in the future, they actually pay a lower interest rate for 9 months, and then a higher interest rate for 19 months, and then back down to a lower interest rate over the 29 and 39-month time period. So you'll want to make sure that you're picking the appropriate time frame for your particular needs and the interest rate that you're looking at. Now, the other nice feature is that Wells Fargo offers things like step rate CDs. Step rate CDs offer a guaranteed interest rate, in this case 1.73%, but if interest rates rise over time, then you get the opportunity to increase your rate over time in the future. And so this offers an attractive opportunity to take advantage of any interest rate increases that occur in the future. This is a great product then for people that think interest rates are going to rise over time. Now you should have a good handle on how CDs work and how they can be used by depositors like yourself. Banks originate the large majority of home and car loans across the United States, which means that they have a huge impact on many people's lives. To get a loan, you'll need to show that you have a steady income, which will let you support the debt you're taking on. A common rule is that mortgage debt cannot be more than 4 times your annual income. So if you make $50,000, for example, you could borrow $200,000 from a bank. 4 times 50,000 equals $200,000. You will need 2 years of tax returns plus 2 recent pay stubs from your employer to demonstrate your income. You also have to have a good history of paying back money you borrow. In other words, you need a good credit score. Credit scores help the bank to judge how risky you are as a borrower and whether or not they should give you that loan. Your credit score is important because it is key to getting a loan for a house or a car. probably the most important role that banks play in most people's lives is providing home loans. Now, your credit score will often be shown via your FICO score. FICO is not an acronym. It's a company, Fair Isaac Company. Your FICO score comes from one of three credit unions, Equifax, Experian, and TransUnion. They collect information on all of your outstanding loans and credit cards. Essentially, anytime you borrow money from someone else, the credit unions are gathering information on you. And they gather information on whether you pay those loans on time in order to determine your credit score. You can check your credit score for free with any of the three credit unions, Experian, TransUnion, and Equifax. Credit scores range from 0 to 850. It's very hard to get more than an 800, and almost no one has less than a 400. A strong credit score is generally regarded as 700 and above, while a weak credit score would be below 600. So you're actually talking about a narrow range for most people. If your credit score is low, focus on paying your bills on time and try to ensure that you don't miss any payments. Eventually, your credit score will go up if you do this, and you'll be in a better spot to get a house, a car, or another type of loan at an attractive interest rate. Have you ever thought about investing in the stock market? This question is a common one for most people unsure how to save their money. The stock market is a system that enables companies to sell partial ownership in themselves to people, to investors, in exchange for cash. Investors get a way to earn a return on their cash that they want to invest by owning a piece of a company. And companies get cash from investors that help to grow their business more. So it's a win-win for both sides. Common stocks, which are usually just called stocks, are critical to successful retirement because they have by far the highest rate of return compared with any other option out there over the last century. Common stock is a certificate that indicates ownership in part of a corporation. When you're learning about stock, you should know that the word stock can be used in different ways. Stock is like a singular version of shares. Shares are pieces of the company. If the company has 1 million shares of stock, then when you own one share, you own 1/1,000,000th of the company. When you buy a share, you buy a part or a share of the company and attain ownership rights in proportion to your share of that company, making you a shareholder, also sometimes called a stockholder. So if you own a share of Microsoft, you're a part owner of Microsoft. To help make sure that the company is being run in their best interests as the owners of the firm, common stockholders get to vote on the most important matters for the company. Common stockholders are entitled to vote on the board of directors and elect those directors and to approve any changes in the corporate charter. Now, in the real world, shareholders don't really pick the board themselves. Rather, they just select from a list of nominees chosen by management, kind of like a presidential election, right? We don't pick the president so much as we pick the president from a slate of potential candidates. This opens the door for management-favored boards, which may not always be in the best interests of shareholders, so you do want to watch out. Now, let's take a look at an example of a real-world stock. I'm here on the stock page for Disney. Now, we're using the Seeking Alpha site, but there's many other sites out there, CNBC, NASDAQ.com, Yahoo Finance, and a variety of others. I happen to like Seeking Alpha because it puts all the information in a single, easy-to-access place. In the case of Disney, one thing to note is that the stock pays what's called a dividend. This dividend, shown here, is the amount of cash that shareholders get back from the company every year in profit. In the case of Disney, it's $1.72 paid out over the last 12 months. Essentially, if you owned one share in Disney, you were entitled to $1.72 in profit from Disney. Now, that might not sound like a lot, but remember, you get that every year for as long as you own the stock. In addition, the stock should presumably go up over time. There are thousands of stocks like Disney out there, But the price of Disney isn't based on some sort of accounting value. Instead, the stock price for Disney is based on the value that investors assign the company based on how much money they think it will earn over time, based on what they think the dividend payouts will be in the future, and based on what they think Disney will earn in cash that helps to grow the company going forward. Now, shareholders have the right to the company's income after bondholders and preferred stockholders have been paid. That's where those dividends come from. If the company you bought stock in goes bankrupt, you're typically not going to be fully repaid. But your liability is limited to the amount you have in that investment. That's important because it lets you minimize the risk associated with legal disasters, legal liabilities, like those that afflicted the asbestos companies in the 1970s and the cigarette companies in the 1990s. Those shareholders didn't owe any more money even after big legal judgments were rendered against those firms. Now, you should have a good understanding of the fundamentals of stocks and why you should think about investing in them. If investing is like a personal hobby of mine, surfing, then I can tell people the one most important thing about managing stocks is to stay on your board. Don't buy or sell based on your emotions. Lots of people panic. Ride out the waves. Do not panic or change your investment in stocks just because they are going down. Set a certain amount in an investment, which we call an allocation, and then stick with it in good times and bad. When you adjust your assets, adjust them based on your expected rate of return and your needs for the future. Your expected rate of return is how much you reasonably expect to earn on an annual basis. Let's talk about what the stock market as a whole has returned in the past 60 years. Since 1966, the S&P 500, a group of 500 large stocks, has returned an average of 11% each year. That's a pretty good rate of return, but it hides an important fact. Returns fluctuate a lot. A 1 or 2% move per day is common, and the markets frequently fall at a sharper rate than they rise. So while gains might average 1% per month for the first 9 months of a year like 2018, they could fall 10% in October, November, and bring the markets to flat for the year. That makes investors feel like they're being buffeted about in hurricane-like stock plunges. You're being thrown around by the winds of change in the market. The reality is that sometimes you end up with the feeling like you're working for free during stock market downturns. That's not unusual. Once you get a portfolio of at least, say, 1 times your annual salary, there probably will be days that you're working for free. For example, if you make $50,000 a year, that means that you earn about $200 per working day. 50,000 divided by, say, 252 working days per year. So a person with a $50,000 salary and a $50,000 stock portfolio would lose $500 on a day when the market falls 1%. That is, that $50,000 times your 1% loss in the market is $500 down. So you work all day and you're still down $300 at the end of the day. $200 in wages minus $500 in investment losses means you're out $300 at the end of the day. Unfortunately, that is how the markets work. It's going to feel really awful when the markets fall, and you'll barely notice when the markets rise. But if you can stay on your board, then on average, over time, your stock market portfolio should increase by about 11% per year before fees if you're broadly invested in the overall market. The important thing and the key for a typical investor is to stay the course. Stock valuation is a key part of figuring out if a stock is a good investment for you. If you buy an overvalued stock, you're likely to lose money. If you buy an undervalued stock, you're more likely to gain money. Buying undervalued stocks and holding them for the long run can quickly help you to increase your net worth. Let me show you what I'm talking about. I'm in the 0203 Begin Excel file. Now, what I've done here is created just a simple little valuation model for us. The valuation on our stock is simply equal to our expected dividend, that is what we think the dividend will be over the coming year, divided by our required rate of return minus the growth rate. The required rate of return is how much we need to earn on this investment given its level of risk, and the growth rate is how fast that company is growing, say sales or top line figures. So in order to fill out this model and get our valuation, we're going to need to draw our data from somewhere. We're going to need to fill in these initial variables. I'm going to do this for, say, Disney. It's a good stock we're probably all familiar with. In order to get this information, I'm going to turn to a website that I'm familiar with, Seeking Alpha. Now, there's nothing special about Seeking Alpha except that I find them convenient to use and all the information's in one place. But you could get most of the same information from Yahoo Finance, CNBC, or a variety of other sources. In any event, I'm on the Seeking Alpha website, and I'm going to start by pulling their dividend. This dividend is shown right here under Div Rate, TTM. This is our dividend rate over the trailing 12 months. Disney paid out $1.72 to shareholders over the last year. So I'll add this to my model for last year's dividend. Now from here, I need to pull information about Disney's growth over time. So I'm going to go to key data and look at their financials. The relevant information I'm interested in is from their income statement. Disney's top line, its revenues, total cash generated before costs from all customers, was $59.43 billion in 2018, $55.14 billion in 2017. So I'm going to pop those figures into my model, $59.43 billion and $55.14 billion. And what this is going to show us is that Disney's growth rate over the last year was roughly 7.78%, just under 8%. Now, what's our required rate of return? Well, that depends on how risky we think Disney is. The average stock returns about 11% per year. Disney's probably a little bit safer than the average company that's out there. So instead of 11%, I'll use, say, a 10% rate of return. That gives me a value on Disney of $83.51. Disney was trading for around $114. So this suggests, at least based on these numbers, that Disney might be a bit overvalued. What could be going on here is that investors might expect a faster rate of growth for Disney in the future than what Disney has done historically. So if we up this growth rate to, say, 8.5%, all of a sudden Disney's valuation is now $124.41, and Disney looks undervalued. The key here is that valuation requires carefully studying the company and then determining what you think is going to happen to the company's profits in the form of their dividend, their growth rate, and their required rate of return going forward. Once you do that, you can come up with a valuation and decide if this is a good investment for you or not. Now you should be prepared to go and apply this type of valuation methodology to your own investment portfolio. To get started with investing on your own, you need to start by setting up a brokerage account. A brokerage account comes from firms like TD Ameritrade, E-Trade, Schwab, Morgan Stanley, and many other firms that are out there. Basically, a brokerage account lets you buy and sell stocks easily and inexpensively. You have to have a brokerage account to buy stocks today. There's no other way, essentially. There are many fine firms that offer brokerage accounts, but they generally fall into one of two categories: full-service firms and discount firms. The full-service firms generally offer more expensive stock and fund trading costs. A typical full-service brokerage firm might charge somewhere between $30 and $100 to an investor for buying or selling a particular stock or ETF. But for the higher price, investors can get personalized assistance in making decisions about their portfolios, written research reports that offer insight from the firm on market conditions, in-person or phone support for questions the investor has, and potentially access to unique mutual funds managed by the brokerage firm. Essentially, you're paying for the other services the brokerage firm offers through the more expensive trading fee. A few firms, particularly in Europe, charge for these other services separately, but that is not common within the U.S. today. Discount brokers are the same thing as regular brokerages, but at a significantly reduced price. A discount broker might charge for the same trade $5 to $10 for buying or selling a particular ETF versus $30 to $100 for the full service firm. But they offer fewer services or lower quality services in general compared to those full service firms. They're less likely to have written reports, you're less likely to have in-person support, less likely to have unique mutual funds, etc. For example, TD Ameritrade, E-Trade, and Schwab are all examples of discount brokers. For you, either a full service or discount brokerage might make sense. The true cost of trading goes beyond the cost charged by the brokerage, though. The moral for investors like you or I is to minimize trading, even if costs are low. Most people trade too much. The real challenge for investors like you is not brokerage commissions, but making bad stock market trading decisions. One way to avoid the issues associated with figuring out what funds or stocks to buy is to use a robo-advisor. Robo-advisors are software programs offered by certain brokerage firms that help investors to make asset allocation decisions. Today, most major brokerage firms, both full service and discount, offer some sort of robo-advisor solution for their clients, but sometimes at an additional cost to the investor. Two examples of robo-advisors and two firms that basically invented the space are Betterment and Wealthfront. Now, the way a robo-advisor usually works is that the program asks the investors a series of questions. These questions are meant to gauge the investor's objectives, what the investor is trying to accomplish over time, what their goals are, and what their risk tolerances are. From there, the robo-advisor turns around and recommends a portfolio to the investor based on the investor's needs. Robo-advisors are useful for investors in that you don't need to know anything about stocks or bonds in order to actually create your portfolio. All you have to know is about yourself and what your objectives are. From there, the robo-advisor handles the rest. Given how useful this is, it's probably not going to be a surprise when I tell you that groups like Betterment, Wealthfront, and other robo-advisors affiliated with discount brokers have expanded very rapidly over time. Go check out some of the brokers that are out there and see which one is right for you. Once you've learned how
طيب خلونا ناخد بريك ناخد حوالي 30 minutes كده وبعديها نرجع تاني نكمل بقية الفيديو. Thank you.
هنام ربعهم واكل ربعهم. هنام ربعهم واكل ربعهم.
No, definitely don't apologize. It'll make it look like you did something wrong. What? No, definitely don't apologize. It'll make it look like you did something wrong. What? Did you tell her to calm down? She's totally overreacting. There's no way she's not. Dude, if she didn't remind you to do it, then it wasn't your fault. No, how would you not be upset if she didn't have supper cooked for you when you got home? Like that is...
هاكل بس عشان عيني متسخة وارد عليك عشان مش عارفة اكتب.
طيب أهلا بيكم. خلينا نكمل الفيديو اللي احنا كنا بنشوفه قبل البريك.
You can either let someone else do the investing for you, or you can do it yourself. If you're very knowledgeable about investing or really enjoy learning about it, then you might enjoy investing on your own. Yet if you're like most people, you might find picking your investments to be difficult, and you might decide to hire someone else to do it for you. One option for having someone else manage your money is called a mutual fund. It's the most common choice made by lay people investing on their own. Mutual funds are more than sufficient for most people's retirement needs. Note, however, that using a mutual fund is not the same thing as hiring a stockbroker or personal financial advisor. I'm talking about having a manager of a mutual fund invest for you. A mutual fund is a basket of stocks picked by a professional money manager on behalf of outside investors who put money into the mutual fund. Mutual funds charge fees based on the amount of money you invest in them. If you invest in a traditional mutual fund, also called an open-ended fund, you can select a particular mutual fund and then send your money to them. Then the mutual fund will pool that money of yours with money from thousands of other investors and invest it in a group of stocks that they think are attractive investment options. if these stocks go up, the investors earn positive returns. And then the investors can sell the mutual fund for more money than they bought it for, and those returns are distributed to the investor. The manager of the mutual fund is an investment professional whose job is to pick a basket of stocks that will increase in value over time, but with a reasonable level of risk. Note, and this is important, there are no guarantees that a mutual fund will make money for you. The investment manager will do their best to pick a basket of stocks that'll rise in value, but in some years, most stocks go down, which means your investments will likely lose money. Think 2008, for instance. With individual stocks, if you're going to invest on your own, you'll likely need to pick 20 to 30 or more individual stocks to invest in. For many people, 2 or 3 mutual funds is plenty for most people's retirement needs. Also, if you're investing with a tax-deferred plan, like a 401k, then chances are high that your employer has already picked the mutual funds you can use. The typical 401k will have a menu of perhaps 6 to 10 mutual funds that a person can choose between. You should try to pick no more than 2 or 3 of these 10 in most cases. To pick 2 or 3 of these funds, you should start by looking for mutual funds that fit your investment objectives. All mutual funds list their investment objectives up front. For many, that investment objective involves trying to beat some sort of a benchmark. A typical mutual fund will often say they want to beat some sort of a stock index like the S&P 500 or the NASDAQ. Or alternatively, some funds will be focused on beating certain bond indexes, like, say, treasury bonds or corporate bond indexes. Groups of stocks like the S&P 500, the NASDAQ, and others are essentially just pools of stocks that tell an investor how well their particular investments are doing compared to the overall market. You can compare yourself against any of these pools, often called benchmarks, to get a sense of your own individual performance. As an investor, you should choose a couple of mutual funds that reflect the level of risk and return you want to achieve. While many investors use mutual funds to invest in the stock market, you should consider a similar option called an exchange-traded fund or an ETF. An ETF is a basket of stocks that trade through an exchange just like a regular stock does. Let's talk about how they work. But first, let me explain what an ETF is versus a mutual fund and how the two differ, because many people often have this question. With mutual funds, you can buy shares as a way to invest money. Those shares are not traded on an exchange. The mutual fund is run by a manager who picks specific stocks to invest in. Also, a mutual fund tries to beat or outperform the market. The ETF is not there to beat the market. It is there to track some part of that market. For that reason, mutual funds are active investments. They're actively picking specific stocks or securities they think will outperform. Mutual funds tend to have higher fees associated with them because of this effort to outperform. In contrast, by buying the ETF, you are just buying a piece of the overall basket or universe of stocks. An ETF is traded on an exchange, and there's no real stock picking involved. You're not asking an investment professional to pick stocks for you. The ETF tracks a particular predetermined basket of stocks, such as the S&P 500. And the ETF is not there to beat the market. It's there to track some part of that market. So these are essentially passive investments. Now, to be fair, there are a few traditional mutual funds out there that are passive and just hold all the stocks in the market. Vanguard is famous for these, for instance. But the majority of mutual funds are actively managed, and the majority of ETFs are passive funds. Last, because ETFs are not attempting to outperform the market, they do not need to employ many portfolio managers or pay for the infrastructure used by a traditional mutual fund. As a result, ETFs usually have lower expense ratios, that is, lower fees for the investor, than mutual funds do. An expense ratio is the cost that you pay to the ETF company. It's a small percentage of the amount of money you have invested in the ETF. Pay attention to this. If you don't know what the expense ratio is, you don't know what you're paying, and you can't manage your money if you don't know what your costs are. A typical mutual fund might have an expense ratio of, say, 0.25% up to 1%, maybe even 1.5%, meaning that each year you might pay somewhere in the range of 25 cents to $1 or even $1.50 per $100 you have invested in the mutual fund. ETFs commonly have expense ratios in the range of 0.1% to 0.2%, about 10 cents to 20 cents per $100 invested. If this difference seems small in dollar terms, that's a fair assessment. It's important to get the fund you're comfortable with and can stick with rather than the one that saves a fraction of a percent in fees, though. In addition to expense ratios, tracking error is also important. ETFs try to track part of the investment universe. Sometimes they do a good job of that, sometimes they don't. We measure how effective an ETF is at tracking its benchmark index using tracking error. Tracking error is the difference between the return on the ETF itself and the return on its underlying benchmark index that the ETF is supposed to match. The less the tracking error, the better the ETF is doing at its job. The key thing I want you to take away here is that you should look at ETFs that have very small tracking errors so that you can get an investment product that performs as it's supposed to and expected to. If you look at this and the expense ratio, you'll be able to considerably narrow the field of investments that might be a good fit for you from the ETF universe. If you think stocks are too risky, then bonds are often a good alternative. When you are a stockholder, you are a true owner of the firm. Owners of bonds, on the other hand, are debt holders or creditors. A bond is a type of debt or a long-term promissory note issued by a borrower promising its holder a predetermined and fixed amount of interest per year and then repayment of the principal at maturity. Essentially, if you own a bond, you know exactly how much the company has promised to pay you each year, plus they've promised to give you all of your original investment back when the bond comes due in the future. Bonds are issued by corporations, by the U.S. government, by state and local municipalities, and a variety of other organizations. There are 5 major features of a bond that investors like you need to pay attention to when evaluating that bond. The first is par value. Par value is the face value of the bond. It's what's returned to bondholders at maturity. In general, corporate bonds are issued at denominations of $1,000 in par value, meaning you could invest $1, $2, $5, $10, $20,000 in the bond. The second major characteristic of the bond you want to pay attention to is price. Prices are represented as a percentage of face value or par. Thus, a bond that's quoted at 112 can be bought for 112% of its par value in the market, not $112. Bonds will return the par value at maturity regardless of the price paid at the time of purchase. The third major characteristic of bonds is coupon. The coupon is the percentage of par value that the bond pays periodically in the form of interest. For example, if James buys a bond with a $1,000 par value and a 5% annual coupon, it'll pay him $50 annually, 0.05 times 1,000, or $25 if the interest is paid semi-annually, every 6 months. Some bonds, called zero coupon bonds, have, as the name implies, a zero coupon rate. Instead of paying interest, these bonds are issued at a substantial discount below the par or face value on the bond. The fourth major feature or characteristic in bonds is maturity. Maturity of a bond refers to the length of time until the bond issuer returns that par value to the bondholder and then terminates or redeems the bond. So it's the length of time until you get your original investment back. And then the fifth characteristic of bonds is yield. This is the rate of return the investor will earn on the bond after taking into account the price that's paid for the bond and the coupon on that bond. In addition to these features, you should also understand bond ratings. Bond ratings reflect the future risk potential of those bonds. There are three prominent bond rating agencies: S&P, or Standard & Poor's, Moody's, and Fitch. Bond ratings range from AAA to D as in default. I like to say that nobody fails and gets an F in bond ratings like you might in school. So investment-grade bonds, or safer bonds, are bonds with a rating above BBB. Then there are riskier bonds called junk bonds, which have a higher return but a rating below BBB. Junk bonds are these high-risk bonds, and they have lower ratings below BBB, so BB or below, by Moody's and Standard & Poor's. Junk bonds are sometimes referred to as high-yield bonds, but in order to compensate for that higher risk, they pay a higher interest rate. A lower bond rating indicates higher probability of default. It also means that the rate of return demanded by the capital markets will be higher on such bonds. Now ask yourself, what type of bond works for you? Consider if you're willing to take on the risk associated with junk bonds and that potential higher return, or if you'd prefer to be safer and have a lower return with investment-grade bonds. There's no right answer. It all depends on your needs and preferences. No matter how well stocks do over time, they are a risky investment. And you, as an investor, need to be sure that you can handle the risk before you ever invest a penny in stocks. In order to mitigate your risk, or at least to help mitigate your risk, you need to diversify. If you're thinking about investing, you might be wondering, how often will your stocks lose money? The answer is quite often, but stay with me. The truth is that in any given year, about half of stocks lose money. So given that, how can the returns on the S&P 500 be almost 11% per year if half of stocks are losing money? The answer is that the performance of the U.S. stock market is powered by a handful of superstar stocks. We don't know which stocks are going to be superstars in any given year, but they will be there. That's where the risk in stock picking comes in. If you miss out on these superstars, your returns are going to be well below average. For that reason, it's often a good idea for beginner investors like you to make sure you have a diversified investment portfolio. What is diversification? Well, it's holding a broad basket of stocks to insulate you from the ups and downs of the market. So, how can you do this? Well, one option is to buy low-cost exchange-traded funds, or ETFs, or mutual fund products, and thus own the market as a whole. Think about it this way. Let's pretend we have a bag of poker chips. There are 10 poker chips in the bag. 9 of the 10 have a value of $10, while the last one has a value of $100. If we pick one chip out of the bag at random, what are we going to get? Most likely a $10 chip, right? But if we owned a tenth of every chip in the bag, if you could buy one piece of every single one of those 10 chips, if you had that average chip, the value would be 9 times 10 plus 1 times 100, all divided by 10, meaning that your average chip would have a value of $19. When we buy a specific stock, it's like trying to pick the one $100 chip out of that bag. Unless you are very confident you know which chip is worth 100 and which is worth 10, you're better off having an average share in every chip. You can do this with an ETF or a broad-based mutual fund. That's the superstar effect in equities. The key here is to be comfortable holding your stocks for the long term so that you can try to take advantage of the superstar effect that is so important to returns. When you understand the value of diversification, you're on the road to building a more secure and profitable long-term financial future. If you buy one lottery ticket every day, forever, for the rest of your life, it's very likely you will be a net loser over your lifetime. Yet, people still play the lottery, even though they know this intuitively. Why? Why is that? The answer is they want exposure to what's called positive skew, being a small amount less wealthy every year in exchange for the chance, albeit a small one, at a very large payoff. Insurance is the opposite of it. People pay an insurance company even though they know, on average, that they're never going to need the insurance company, all so that they can avoid the risk of having a very large loss at some point during their lives. And that's how insurance fits into your personal finances. Insurance is related to this idea called risk aversion. Risk aversion means that investors want to avoid risk and are willing to pay a premium to ensure they are protected in the event of a big loss or tragedy. For instance, think about the example of carrying home insurance to protect against the risk of a fire. Individuals generally prefer to minimize their risk of large losses while at the same time maximizing their chances of big gains, even if it costs them money on average over time. There are three primary types of insurance that you should be aware of and use as a way to hedge your risk in your finances: health insurance, life insurance, and property and auto insurance, which fall under the general bundle of what's called P&C, or property and casualty insurance. Health insurance protects against losses related to a person's health. Life insurance provides a payout after a person dies and helps to provide for the deceased family. And property and auto, again called property and casualty, protects in the event of a disaster that damages one's property. These three distinct classes of insurance all represent different types of businesses, but they all operate on the same premise. The insured person, that's you, pays a premium to be protected in the event of a major negative unexpected event. Remember, a premium is the monthly bill that you pay to the insurance company. The insurance company's business model is built around the risk aversion people feel and the fact that people will pay a premium to avoid these issues. Three major metrics define the insurance business. The loss ratio is the amount of every dollar in premiums that gets paid back out to insured people. For instance, if a home insurance company brings in $1 million in premium payments and pays out $800,000 to cover fires, floods, other sorts of disasters, what have you, then the loss ratio is 0.8 or 80%. 800,000 divided by 1 million. The expense ratio is the amount of every dollar in premiums that gets used by the insurance company to pay their own office and overhead expenses. For instance, if that insurance company brings in $1 million in premium payments and then spends $120,000 on office expenses and customer service for their customers, well, then the expense ratio is 0.12 or 12%. That's $120,000 divided by 1 million. Finally, the combined ratio is the amount when the expense ratio is combined with the loss ratio. It's the total amount of every dollar in premiums the insurance company spends on all of its costs plus its payouts to insured people. In our example, the combined ratio is 800,000 plus 120,000 divided by 1 million. This then tells us that the profit for the insurance company is 8%, which is just 1 minus that combined ratio. Now you should have more of an understanding of how the insurance industry works and why it's valuable and necessary for people like you. There are two major types of life insurance: term life and whole life. Term life insurance is the simplest form of life insurance. It pays only if death occurs during the term of the policy, which is usually from 1 to 30 years. Basically, you buy term life insurance, say with a 10-year term. Then if you die in the next 10 years, the insurance pays out to your family. If you die in 15 years or 11 years or 20 years, the insurance does not pay. There are two basic types of term life insurance policies: level term and decreasing term. Level term means that the death benefit stays the same throughout the duration of the policy. Most of the term life insurance that people buy today is level term. Then there's that decreasing term, which means the death benefit drops, usually in 1-year increments, over the course of the policy's term. The alternative to term life is whole life. Whole life, which is sometimes called permanent insurance, pays a death benefit whenever you die, even if you live to be 100. Whole life encompasses several subcategories, including traditional whole life, universal life, and variable life. With traditional whole life, both your death benefit and your premium are designed to stay at the same level throughout the life of the policy. Traditional whole life insurance has a simple flat rate premium each month. The cost per $1,000 of benefit, that is the $1,000 that your beneficiaries get when you die, increases as the insured person ages, and it obviously gets very high if the insured person lives to be, say, 80 years or more. So the earlier you buy that traditional whole life insurance, the cheaper the cost will be per month. The later you buy it, the more expensive it'll be per month. Next, we have universal life insurance, which is just a type of cash value life insurance. It's just like traditional whole life insurance in that you get a payout whatever age you are when you die. This type of insurance acts a bit like a savings account too. You can put extra cash into it, and the cash will be paid out to your family with interest when you die. You can also take extra cash out of the universal life insurance before you die if the policy is overfunded. There are very specific rules about taking money out of the policy, though, so you do need to be careful if you're going to do this. Then we have that third category, the variable life. Variable life insurance builds a cash value over time. In a variable life insurance policy, or VL, the cash value can be invested in a wide variety of separate accounts, similar to mutual funds. Unlike a universal life policy, though, the value of the VL at your death depends on which specific investment choices you made. So it's similar to investing your money in mutual funds. If you make good investments, those mutual funds are worth a lot. If you make bad investments, they're not worth much. Variable life works the same way. Both universal life insurance and certain types of variable life insurance, called variable universal life insurance policies, allow you to pay either a lot or a little in premium each month, and the value of your policy changes based on that payment. I know there's a lot here, but now you can consider which life insurance is right for you. Do you want insurance for a specific period of time? Consider a term life policy. Want insurance throughout your life with a fixed cost? A whole life policy might be the best choice. Want to be able to vary how much you pay into the policy depending on your budget each month? A universal life policy could be a good choice then. Or if you want to combine life insurance with your investing acumen, a variable life policy might be the right fit. It all depends on you and your needs and objectives. Homeowners insurance and auto insurance are often bundled together because both help to protect you from losses related to two of your most valuable possessions, your home and your car. Homeowners insurance and auto insurance both fall under the umbrella of property and casualty, or P&C insurance. Remember, this insurance is generally not optional. If you have a car, you must have car insurance by law. If you have a house and you have a mortgage on it, the bank will generally require that you carry homeowners insurance. So P&C is more a question of which policy than whether or not you want to carry one. There are several key terms you might want to consider when evaluating which P&C option is right for you. The first term you should be familiar with is the premium. The premium is the amount that you must pay to the insurance company each month. The level of premiums will range based on your property value and the choices that you make in your policy. The insurance company collects premiums from thousands or more likely millions of customers, most of whom won't have an accident in their car or a problem with their house most of the time. So most of the time, you're not getting any direct benefit from paying your premium. But out of the millions of insured people, a few have a major accident or a disaster each month, and the insurance company uses everyone's premiums, everyone's payments to cover those problems when they come up. So the premium is essentially the price of the insurance. A lower premium is better and cheaper, but remember that a lower premium also likely means less insurance protection and worse customer service. The second key term to be aware of is your deductible. The deductible is how much you have to pay out to cover a problem or accident that comes up before the insurance company pays anything. A deductible in the range of, say, $500 to $5,000 is pretty common. The higher your deductible, the less risk there is that the insurance company will have to pay for any damage that occurs to your property. And as a result, the higher your deductible, the lower the premium will be. Finally, the declarations page in your insurance policy outlines your covered amounts, the total maximum amount that the insurance company agrees to pay if a major accident causes huge damage to your property. The lower the covered amounts are, the lower the premium will be, because the lower the insurance company is on the hook for in the event of a fire, a flood, or a tree fall. So to sum it up, higher deductibles and lower covered amounts lead to lower premiums or monthly bills for your insurance. But you shouldn't just look to minimize your premium. Decide how much risk you want and need covered, and then determine what's the right mix of premium versus coverage and deductible for your personal circumstances. Health insurance is generally provided by your employer, or alternatively can be purchased through government-run exchanges like the famous Obamacare, which are often set up on a state-by-state level. Kicks in. You can have a free option, often provided by employers, and they are a great tool to use in combination with insurance. Say you have a high-deductible health insurance plan, one where you have to pay the first $1,000 or $2,000 in medical expenses before the insurance kicks in. You can save money tax-free in an HSA account. The deductible is what you have to pay before your insurance kicks in and covers the remaining medical fees. The deductible cost varies based on your plan. For example, if you have a car accident and you have to go to the hospital, that is where your insurance would kick in once you cover the deductible with your HSA. The attractive feature about high deductible health insurance plans is they're quite cheap, mostly because they're there to cover you in the event of a true medical emergency or medical costs exceed $1,000 or whatever the deductible is. You can contribute up to $33.50 a year for an individual or $66.50 for a family in an HSA to meet these deductible expenses, and there is no tax on the contributions. Now, be aware these figures do change over time, but $33.50 for an individual and $66.50 for a family are the current levels at the time that we created this course. If you're 55 or older, you can also contribute an extra $1,000 to an HSA. You can withdraw that money from your HSA to pay for allowable medical expenses, including co-pays and items like eyeglasses. If you don't spend the money, it rolls over indefinitely. And as long as you save your receipts, you can withdraw money to reimburse yourself for expenses that you paid years ago. If you're 65 or older, you can withdraw money for non-medical reasons without penalty, but you have to pay taxes on money you withdraw in that case. If you withdraw the money before you're 65 for any reason besides medical expenses, you have to pay income taxes and a 20% penalty. If you don't need the money for medical expenses, you can invest it just as you would other retirement savings. Investment options for HSAs vary from company to company, but usually you can invest your unused HSA balance in one of a number of mutual funds. This is a great option because you can save $66.50 a year. Remember, that's the max for a family HSA early on in your career when you're less likely to need it. That money is then tax deferred, so you won't pay taxes on that $66.50, and you can invest the untaxed funds in a mutual fund within the HSA. The untaxed money earns a return through those mutual funds over time. And so if you can avoid using the money until you need it later in life, you'll have built up quite a nest egg. This is a great strategy for building wealth while also having a good reserve set aside for any medical emergencies that do come up. Do you have a high deductible health insurance plan? Do you think you will have medical expenses that you need to pay for? And can you afford to take a withdrawal from your paycheck for the HSA? Get started by answering these 3 questions before deciding whether an HSA account is the way to go for your health insurance plan. Planning for retirement can be scary and overwhelming. So let me give you 5 key principles you can use to make it easier. First, develop a good retirement plan. You want to write it carefully and follow it closely. To start, define your financial needs by answering a few questions related to your vision, goals, plan, and budget. Ask yourself, what is my vision? Where do I want to go over time? Second, what does your budget look like? Third, what are my personal and family goals? What are my lifestyle costs to retire at 65? What is my risk tolerance? Second, choose the best retirement vehicle for your needs and use them wisely. It's not what you make, but what you keep after taxes and inflation that makes you wealthy. Use tax-advantaged retirement vehicles to your advantage. This includes employer-qualified plans such as 401ks and 403bs. Then there are individual and small business retirement accounts such as IRAs and SEPs. Third, check yourself regularly to make sure you are on track. Monitor performance, rebalance, and reevaluate as needed. Fourth, and perhaps most importantly, start today. The longer you wait to start, the more money you will need for retirement. Have your money earning money to help you reach your retirement goals. Start now. You may have critical questions about retirement planning, like, will I be able to retire? At what age can I accumulate enough to retire? How much do I need? The solution to these questions at a high level is this: successful asset allocation. Asset allocation refers to dividing your money among several different investments or asset classes. The first step is to know your financial needs. Figure out how much you need in order to retire at 65. This includes your vision, goals, plans, budget, and risk tolerance. Second, consider using the age rule of thumb to allocate your assets. That rule says that whatever your age is, that percentage of your assets should be invested in bonds. If you're 75, 75% of your assets should be in bonds. If you're 30 years old, 30% of your assets should be in bonds. The remainder of your assets should be in stocks. This rule is a good starting point for most investors. Keep in mind, if you're younger than 40 years old, a small additional tilt towards stocks often makes sense. Perhaps an additional 5% in stocks, so 30% in bonds instead of 35% for someone who's 35 years old. That approach should really only be considered if you're less than 40 years old today and if you have a long time to invest. And the theory is that it helps to account for the likely increasing lifespans that younger people will see in the future as a result of improved technology. Again, all of this is only a rule of thumb, so you'll need to adjust it to your specific circumstances. In addition, consider using the 4% rule. The way this rule works is if you want to retire at the age of 65, withdraw only 4% of your total portfolio every year. If you do this, the value of your portfolio will remain significant over time, no matter how long you live. The value will fluctuate as market conditions rise and fall, but you won't run out of money. An investor who's 65 years old with $1 million in their portfolio will still have about $1 million in savings when they're 95 years old, even after withdrawing 4% every year from the time they turn 65 to the time they turn 95, provided they invest the same proportion of their assets in bonds as their age, meaning 30% in bonds when they're 30, 65% in bonds when they're 65. It'll stay constant because of a few assumptions based on historical figures. Here, specifically, we're assuming the average return on stocks will be about 11%, and the average return on bonds will be around 6%. If we assume inflation of 3%, which is about the average over the last 40 years, and then subtract that 3% from our 11% total return, then stocks have an after-inflation return of 8%, that is 11 minus 3, and bonds have an after-inflation return of 3%, that is 6 minus 3. If you want to apply this rule and start withdrawing 4% of your savings each year to live on starting at 65, that means you'll need 25 times your annual expenses. If you need $50,000 to live each year, you'll need 25 times that to retire. so you should have at least $1.25 million. The key is, when you do retire, do not withdraw more than 4% of your portfolio each year, no matter what happens in your personal life or in the stock market. So that means sometimes you'll have more money each year, sometimes you'll have less, but on average, it'll work out to about $50,000 annually. Last, consider this. In 1802, just $1 effectively invested in a broad basket of U.S. stocks would be worth more than $8 million. Now, no one lived to be 200, of course, but with successful asset allocation and financial planning, a relatively small amount of money can result in a significant sum in a decade or two. That's the point. Keep this in mind as you prepare for your retirement and build your financial portfolio. You might have heard about different types of tax-deferred investments without even knowing it. The two popular ones are 403Bs and 401Ks, but you need to know the high-level opportunities before you can invest in one. To begin with, tax-deferred investments are almost always a good option if your employer offers it. It's like a free raise. What I mean by tax-deferred investing is investing tax-free, but paying taxes when you withdraw, plus a penalty if you withdraw early. Withdrawals of gains on your investments prior to age 59.5 typically subject you to a 10% penalty tax, in addition to the regular taxes owed. This penalty is to discourage you from withdrawing early. The IRS allows you to grow your funds tax-deferred as an investment to encourage you to save for retirement. So they penalize you if you want to use the funds before you retire. I mentioned a moment ago there are two major types of tax-deferred investments, 403Bs and 401Ks. Let's start with 401Ks. For most people, this is the easiest and best place to start investing for retirement. Let's take Sam, who's decided to open up a 401K. Her money is withheld through payroll deduction, but she can save up to $19,000 of her pre-tax income. But the number goes up a little bit each year. It's $26,000 though, if you're 50 years of age or older. Now, Sam's company offers employer matching. This means they will likely match at least part of her 401K contribution. Many firms match up to a specific percentage of an employee's 401K contribution. For instance, Sam's firm might match the first 5% of her salary in her 401K. If she earns $50,000 a year and contributes 5%, or $2,500 of her salary, her firm would contribute an additional $2,500 to her 401K for her. Now, let's pretend Sam leaves her job. Well, she can roll the account over into her new employer's 401K or into her own IRA. Another big tax-deferred program is called the 403B. It's very similar to a 401K. In fact, the main difference is the 401K is usually offered by a for-profit company, while teachers and other employees of nonprofits are generally offered a 403B instead. So if Sam, who I was talking about a moment ago, works for a for-profit company, she isn't a candidate for the 403B option. Now, those are the two major tax-deferred programs. There are other ones out there, but these are the big two. Consider what plan is right for you. Then ask your employer about tax-deferred retirement plans and employee matching. Study your options carefully and pick the one that's right for your needs. Many people take advantage of IRAs and SEP accounts for their investing needs. Let's start by talking about traditional IRAs. An IRA is an individual retirement account. With traditional IRAs, these are tax-deductible investments, and then the withdrawals in retirements are taxed. In an IRA, anyone can contribute up to $5,500 per year, or $6,500 if you're over the age of 50. The money grows tax-free. Importantly, you can contribute to both your IRA and a 401K. If you're not covered by a retirement plan at work, you get the full tax deduction no matter what your income is, unless you file jointly with a spouse who has a retirement plan at work. If you are covered by a retirement plan at work, to deduct your IRA contributions from your taxable income, you must make less than $71,000 annually for single filers or $118,000 for married filing jointly. These figures change over time, so be sure to check the most recent levels from the IRS when you're applying this to your own personal circumstances. Next, we have Roth IRAs. With a Roth IRA, you get no tax deduction for your contribution, and instead you're contributing after-tax dollars. But the money that you earn grows tax-free, and you pay no tax on withdrawals after you reach the age of 59 and a half. Plus, unlike traditional IRAs, there's no mandatory withdrawal at the age of 70. This is different from what would happen with an investment account, such as a mutual fund, where you will be taxed on the profits when you withdraw. For example, let's take Sam, who has invested $10,000 into a mutual fund, and it turns into $15,000 in 5 years. She will be taxed on that $5,000 profit when she withdraws it all. On the other hand, if she had the same growth for $10,000 in a Roth IRA, she wouldn't be taxed. She could take out the $15,000 at retirement without any tax cost or consequences at all. That's a big benefit of investing in a Roth IRA. To contribute to a Roth IRA, you must make less than $131,000 if you're single or $193,000 if you're married filing jointly. Again, these figures change over time, so check the relevant ones with the IRS, but that's the approximate level. You can contribute to both a Roth IRA and a traditional IRA, but the limits apply to your total contribution. Some people who make too much to contribute to a Roth IRA contribute to a traditional IRA and then convert it into a Roth later. It's got the same tax benefits as a 401k, but you can put more money into it. Finally, we have SEP accounts. SEP stands for Simplified Employee Pension, and this kind of account is primarily used by the self-employed or the small business owner. As the employer, you can contribute up to 25% of your income, or in the year 2019, $56,000, whichever is less. Now, the caveat here is if the business has employees, the employer must contribute for all who meet certain requirements, like how long they've worked at the business. For that reason, SEP accounts are particularly great for one-person businesses. If you want to prepare for retirement, traditional IRAs, Roth IRAs, and SEP IRAs can be good options. These IRAs can be set up through a standard brokerage account with anyone from Morgan Stanley to E-Trade. So if you think they might be right for your unique needs, check with your broker on how to get started in setting one up. In this course, we've covered a range of financial basics, from personal savings to making investments to insurance and retirement. Let's go over the key points I want you to take away. First, in general, you're better off picking a portfolio allocation that meets your financial return expectations without taking on too much risk. Second, it's a good idea to choose a combination of stocks and bonds based on something like the age rule of thumb. Whatever your age is, that's how much most of us should have invested in bonds. It's usually a bad idea to have all of your savings in either stocks or bonds. Third, if you pick a healthy asset allocation, when you reach retirement, you should be able to withdraw 4% of your retirement savings every year and never run out of money, no matter how long you live. To figure out how much you need to retire, simply multiply what you expect to spend every year by 25. Fourth, always remember that not all stocks are created equal. While the average stock over time has returned about 11% per year, not all stocks are going to do that. Some will have a higher return, others will have a lower return. Value stocks tend to have returns closer to 13%, but they're a little riskier. Growth stocks have returns averaging about 9% or so, but they're not quite as volatile. Finally, taxes. Your investment allocation needs to take into account your personal tax circumstances. I've enjoyed this opportunity to talk to you about the financial basics you should know, and I hope you've walked away understanding a little more about how to structure your investment portfolio and prepare your finances for the future.
شكرا جدا لالتزامكم بالحضور النهارده. عايزه اراجع معاكم كده كام حاجه وكام بوينت قلناها الصبح. بليز ما تطلعوش، يعني انا مش قدامي كتير، بس عايزه يعني نفكر بعض كده بكام حاجه. اول حاجه هعدي سريعا على اللي احنا عملناه النهارده. احنا حضرنا 3 فيديوز. الفيديوز اتكلمنا فيها بشكل يعني مبسط عن البنوك وطريقه عملها ومجموعه من الخدمات اللي البنوك بتقدمها للافراد، وعرفنا اكتر عن الادخار والاستثمار. بكرة إن شاء الله هنكون بنكمل برضو محاضرات زوم، هتكون برضو بنبدأ من الساعة 9:30. الحضور بكرة برضو مهم، فخلينا نكون حاضرين في الميعاد، وخلينا برضو نكون فاتحين الكاميراز بتاعتنا. خدوا النوتس مهمة قوي زي ما كنت بقول في الأول، عشان تقدروا تكونوا بترجعوا لها منين ما تحبوا قبل كمان الامتحان بتاعنا هيكون يوم 7/7 إن شاء الله. الساعة وبقية التفاصيل هتكونوا بتعرفوها كلها عن طريق الإيميل. فبليز ضروري قوي قوي تكونوا بتتابعوا الميل بتاعكم، منين ما يجيلكوا ميل فيه كل التفاصيل محتاجين تكونوا بتشوفوها وبتتفاعلوا معاها. واخر حاجه انه يعني بكره هيكون يوم عندنا فيه محاضرات مهمه عن يعني مواضيع تانية يعني مختلفه عن النهارده ومهمه، فمهم جدا جدا ان انتوا تكونوا حاضرين. لازم الانترنت يكون كويس، ولازم زي ما قلت الكاميرا تكون مفتوحه. وبس best of luck ان شاء الله، واشوفكم بكره.